Well, hello, active traders, and welcome to our Trading Success Summit. It's great to see all of you here. We've got a really big turnout, just under 1,200 people in today's session. As always, all information's for educational use only. Leading off, our presenters are really pleased to present Tom Sosnoff from Tasty Trade. Tom, it's great to have you here today.
Hey, thanks, Ken. Thanks so much. Hello, everybody.
Here, let me make you the. Oh shoot! It's not letting me change presenter. Just a second here. Let me. Okay, Tom, you should be able to take control of the presenter screen and take it away.
Awesome. All right, thanks. Thanks so much, Ken, and welcome, everybody. It's been kind of a, do you just want me to take over from here, and I have about a half hour? Is that how this works?
Yeah. Take it away. You're a genius. I'm really pleased to have you here. It's a real honor, so thanks. Whatever you want to talk about for the next 30 minutes, it's all yours.
That's great. And every time I get a chance to talk to a new audience anywhere, we love it. My name is Tom Sosnoff, and like Ken said, I've been doing this for a while. This is not my first rodeo. I've been on the customer side of the business now for 20 years. Just to give you a little background, I know there's people on here that don't know me, so welcome. I've been on the customer side of the business since 1999-2000, which is the side of the business we're on right now. And prior to that, I was on the market making side of the business for almost 19 years on both sides. So I've been doing this for quite some time. One of the things I love about having the opportunity to build, having the kind of the privilege, honor, whatever you want to call it, to build really cool technology is that after we build technology, we get to back into lots of different ways to kind of use that technology. And so what I'll have a chance here today to do is to show you kind of some of the cool things that we've built technology-wise and how the content that's available to you today is just so much of a game changer. This is the new second since my first were 2009. And after that, we started a company called Tasty Trade, which was content. And I'll tell you exactly technology that allowed customers access to all different types of products and strategies. What we didn't realize in the process was there was actually more to it than that. And we realized after we sold Thinkorswim that the marketplace was kind of missing some really cool content. So we decided to go out and build this company called Tasty Trade. And Tasty Trade was designed to be a different kind of financial media. It was designed to be quantitative, analytical financial media that only talked strategies. No guests, no news, no technical, no fundamental analysis, just pure math. Everything should boil down to math and just pure quantitative, strategic approach to trading. To complement the mission, we needed two more things, which we didn't realize at the time. We needed to build new technology again, because since we no longer own the platform that we had originally built, we needed to be able to control the way our technology integrated with our content. And so we built this platform called Tastyworks. We also needed to be able to control the fee structure so that we could reduce fees down to a level where individual investors could, where they can make, where they could actually make money because the fee structure was right. So we figured out a way to reduce fees by about 80%, and we figured out a way to increase the speed of a retail platform by about 80%. So this platform that you're going to see today, called Tastyworks, we launched on January 3rd, 2017, and it's the fastest growing piece of technology in the marketplace today for online trading. And when I say the fastest, it's because it's built on high frequency middleware. So it's virtually the same thing as you would, as high frequency firms use, except this is for retail investors. And what that means is it's not a huge advantage, when you're routing orders, but you're not disadvantaged. So your orders go in as around 20 milliseconds, and your pricing is about 80% cheaper than virtually any other firm. So imagine a really fast piece of technology with no throttles on the data, no throttles on the order flow, and it's built for derivative traders and also stock traders. But the majority of our business is derivatives. So we're about 5% stock, about 80% options, and about 20, let's call it around 20%. I know that's going to equal 105, but mix and match a couple of odd lots in there. And it's about 20% futures, a little less than 5% stocks, a little less than 80% options. And that's how people, utilize this platform. The neat thing about Tastyworks too is that it's one simple page. So rather than having screens that pop up all over the place, rather than having all this confusion in front of you when you log on to a piece of software, Tastyworks, you can see my cursor here. The left-hand side of the page is is just a market view. The middle of the page is where everything takes place, and the right-hand gutter, this over here, is where you can watch our live video streams, or you could, for example, you can change that back and it can be a chart if you want it to be. There's just lots of different things you can do inside this platform. And your orders for the day, like everything that, everything that, for example, I filled in this platform today is over here, and all your working orders would be displayed here if there were working orders. All the trading takes place in this middle piece. And I think I'll take you through some kind of just what makes us a little bit different. And especially, again, because a lot of you, this is your first time, listening to me speak. And I on the one hand, I'd love to woo you and get you to obviously check out our software and download our stuff. But the other hand, I want you to understand that there's a method, there's a methodology behind this. There's an approach. We first trade a little different than everybody else. Most people on this platform are pretty active, and not because they're such a thing as professional traders, because in my mind, nobody's a professional trader anymore. Everybody's on a level playing field. But the difference in this platform is we just approach things. So just as a quick little look-see here, I typed in Qualcomm, not for any particular reason at all, just because, as you can see on the left-hand side of the page here, I have a bunch of different Qualcomm positions on, and I just trade it every once in a while. And these are obviously all configurable by space. If you type in any symbol, or if you were to just click on any symbol here, one of the neat things about the platform is, for example, if I click on Apple, just as an example, Apple will pop in the middle here, Apple chart will pull up over here, Apple positions will pull up over here, Apple will pull into the order entry bar here, Apple will pull up on a charting tab here, Apple will be in the watch list and Tasty Trade and in the history, everywhere throughout the whole platform. It's designed so that Apple pops in anywhere. If I want to go back to Qualcomm, just because I wanted to give you some real simple examples, if I go back to Qualcomm, I can look at things many different ways here. We have a couple of different order entry views. So if I go to Qualcomm, the stock's currently trading at $72.70. But what's interesting about the way we approach trading is that we look at the IB rank first, that's implied volatility measured against itself. That takes 1 year of implied volatility in Qualcomm, measures it against itself, and then ranks it on a scale of 1 to 100. Right now it's at the 52 handle, which means it's relatively high. because volatility by definition, although it is mean reverting, it also clusters, which means that when it gets cheap, it tends to cluster cheap, but when it's high, it's a little more attractive. Qualcomm volatility is high right now. If you want to trade stock in Qualcomm on the platform, you just click on the bid to sell, click on the ask to buy, and it pops in right here. There's no separate windows, there's no separate pages, nothing else pops up. It's simple as can be. If you wanted to change the quantity, for example, from 100 to from 500 to 100, you could set your default whatever you want. I'll just show you real quickly. If I want to route an order, I just hit review and send twice, filled. And these, by the way, everything I show you here is real. We don't do anything that's not. And if I want to sell it back out, I can. There's lots of different ways, but this sold it back out. Just to give, I want to give you just an idea of the speed of the platform and everything else. We have a little ding associated with the platform. We say we like the ding. If you trade options, which most of us do, our option layout's real simple. We have all the months. We show you if there's an earnings by putting it in purple. We show you the number of days to expiration in the middle, and we show you the implied volatility of each one of the months, and then we also show you the expected move for that month. But if you open up the platform, like I will here in July, and I'll reduce the number of strikes just so you can see, so it looks a little cleaner. We show a couple of different things here. First of all, we show this brown line in the middle is where the stock is currently trading, and this dotted the dotted line shows approximately 1 standard deviation. So you kind of know where, like range bound, where something is right away. The other thing that's nice about the platform is it doesn't recognize anything. So what that means is everything is configurable. So for example, if you wanted to, let's say you're a little bearish in Qualcomm and you wanted to sell the 75 calls. Let me open up a couple more strikes so you can see a little bit more. Let's say you wanted to sell the 75 calls. You just click on the bid. Let's say you said, you know what, I just want to make this defined risk. So I'll buy the 77 half calls. Now that's a spread, so you just clicked on the offer. Let's say you wanted to say, you know what, I actually want to collect a little bit more money than this. So you can move by just dragging the strikes. You can go from 77 half to 80. This is the best platform in the world for option traders. Let's say you wanted to make this a little bit wider and just do the 72 and a half, 80. You just click and drag. So everything is dragged. You don't have to go start clicking all over, look for defined spreads or look for recognized spreads or anything else. Then if you have this call spread on, this short call credit spread, and you said, you know what, maybe I want to turn this into an iron condor by selling the 67 and a half puts first. Well, this spread here would be actually considered a jade lizard, selling the 67 and a half puts and selling the call spread above. And then if you buy the 65 puts, now you have an iron condor on. And the beautiful thing about the Tastyworks platform is it doesn't care what you do with this platform. It doesn't, with this spread, it doesn't care if you widen the strikes out on one side and make it a skewed iron condor. And it doesn't care if you change the volume on one side or the other and do like 3 call spreads versus 2 put spreads, or 3 put spreads versus 2 call spreads. The other nice thing is we also show this to you in a curve mode, we call it. So we actually give you a visual layout if you prefer to see that. This is the distribution curve in Qualcomm, as you can see here, and this is the area that you win, and this is the area that you lose. And if you wanted to, again, widen the strikes out, you could just drag these tiles, and that's a skewed iron condor. Move it back to a regular iron condor, just do that. And the red area is where you lose, the green area is where you win, and you can look at, on this, look right here, it'll show you your initial, your info. Your pop is probability of profit. In this case, it's 53%. The extrinsic premium is $540. The P50 is the probability of reaching 50% of max profit. So if you sell something for $1.08, max profit's $1.08, max profit's 54 cents. The chances of reaching that are 63%. It's the only platform that has that kind of information. We do it all based off of, we use Kelly criterion, you base it off of 1,000 different instances of what's happening here. We then show your delta, your theta, you know, max profit, max loss, kind of everything else that you know, if should you want to see it. The platform, I'll take you back to the table mode for a second, and that's kind of the neat. One of the neat things about the platform is you can tweak it, adjust it, roll everything. Nothing is more than a click and a drag. And so if you're trading futures, if you're trading stock, and if you're trading options, it's all from the exact same interface, from the same platform. And a couple of other neat things. We only charge commissions to open trades. We don't charge any commissions to close trades. So you only pay commissions on one side to open, and you pay 0 to close. So anybody trading on the platform, you pay to open, you pay nothing to close. So you buy a spread, you pay $1 a contract to open, and to close it, you pay nothing. And there's one other cool thing we do. We cap everything at $10. So if you wanted to do one spread, it's $1. But if you wanted to do 10 spreads, it's $10, and 100 spreads is $10. 50 spreads is $10. 20 spreads is $10. So for people that like to trade some decent size, or people that like to do, sell a lot of small things or buy a lot of small things, you can buy 1,000 options for $10. We don't care. Everything caps out at a max of $10 and a minimum of $1. And every customer on this platform pays the exact same. Nobody has any special deal. So it's not like if you called, Schwab or TD or E-Trade or anybody else, and you try to negotiate a special deal and you have no idea. It's like going to a car dealer. We don't do any of that stuff. Every single person has the exact same rates. Everything works the same for everybody. You pay to open, you pay nothing to close for stocks, options, and futures. And it's simple, it's fast, and I'll show you something else here. On the left-hand gutter over here, these quotes are not throttled, which means they come direct to you from the exchange. There is no other platform I know of that doesn't throttle their quotes. So that's a huge advantage because you're seeing everything in real time. We don't slow down any of the order flow. This, like you saw before, it's all 20, 25 milliseconds, and nobody's even close to that. And then the fee structure is about 80% less, and the content is also built into the platform. So if you want to watch, for example, if you wanted to watch what we're doing here locally at Tasty Trade, you can just turn on the TV. We don't show any outside news sources, but that's because we're very self-contained. In addition to the curve mode, we also have an active trader interface, and the active trader interface allows you to trade, stock or futures, super quick. Think of it like a waterfall type thing. And we also have a really complex analysis tab that lets you dig into. You can adjust time and price and volatility and theoretical values and everything else to see what your trade would have looked like at a certain time. So it's just a very different, again, self-contained platform that was designed and built by the same people that we built Thinkorswim with 20 years ago, but it's 17, 18 years newer. Now, one of the things that Ken wanted me to talk about was just to kind of talk about volatility and how it impacts trading and different different ways that we can use the platform to our advantage. One of the things that we do when we're trading is we look for underlyings with high implied volatility. It allows you to sort by high implied volatility rank. Now these are just underlyings where I have positions in. Let's find something high option volume. So here's underlyings that have high option volume, and we'll sort by IB rank. As you can see here, there's a couple of stocks starting right off with gold, which has an IB rank of 92. So let's take a look at gold for a second. So again, all you do is click on gold. Gold pops up on the top of the page. Gold chart pops over here. Gold GLD positions popped in over here. And again, the beauty of the platform is there's no switching pages. There's no going to different screens. There's no switching pages. There's no windows that pop up anywhere. There's no extra boxes. There's not all this crazy stuff you have to do. It is designed to be all in front of you. And gold's rallying nicely. As you can see, the gold futures over here, they're up $4.50 today. And you can trade futures on this platform right with ETFs. Well, we'll go to the ETF because it's smaller. It's about 1/10 the size. And let's say, because gold's had a monster run up, and I'll show you this real quickly. This is gold. We would call this move kind of hyperbolic at this point, or all the way up here. And I'm not a chartist, and I just wanted to give you just a quick little view. Technicals don't come into play at all for us, but sometimes to get a visual of where gold's been and to where it is today is kind of good. So obviously, you know, I'm a contrarian. Gold's at the top end of its range. Let's talk about a bunch of different things we could do in gold. Well, for starters, if the stock is 132.85, one of the things that we can do is we can sell some out of the money calls. So what I'll do here is the market on these calls is 176, 178. I'll put an order in at 177, and I'm not filled yet. This order is working. One of the neat things is now the market's 215, 217. If I wanted to change it, I could just hit replace order and just reduce it by 1, hit review and send it. Now it's my offer at 176. See my offer right up here. Another thing we can do if we're bearish in an underlying like gold, let me give myself some more room here. Another thing we can do is we can sell an out of the money call spread. So I'll sell the 133s, I'll buy the 135s, I'll collect a little less than 1/3 the width of the strikes. My preference is to collect 1/3 the width of the strikes. Strikes are $2 wide, 1/3 the width of strikes would be 67 cents. So what I'll do here is I'll adjust my trade a little bit, get closer to a little over 1/3 the width of the strikes, reduce this trade to the mid price of 72 and route it. Still, it's not filled yet, but we'll see what happens. Because those are, I'm coming in at mid price here, so it's a little bit higher than the current market. Another way to get short gold is potentially you could buy a put spread, but the problem is since IV rank is so high, I'd rather sell some call stuff. So one of the other things that we're going to do here is we're going to buy the 133 calls and sell 2 of the 135 calls. And the reason we do this is called a ratio spread. And we're going to do this ratio spread for about, I probably can do it for about a 55-cent credit. And that one's filled instantly. So, you know, let's see if we can get fills here on these other trades, and I'll review them for a quick second. And let's see here, we're gonna have to go down a couple pennies here. So I filled the naked call, I filled the ratio spread, and on the call spread, it's still, mid price is 71, the bid is actually 69, and I filled it at 70. And I just wanted to show you kind of, you know, the simplicity of this platform here. If I look at GLD, here are all my fills right here. I didn't have to go to another page. I didn't have to look anywhere for that. My position is all right here. I just hit it a little bit so I have more room to work with. I can close this chart up here and give myself a little bit more room. My filled orders in GLD are right here, and I still have GLD on this page here. And if I choose, I can see my orders on this tab here as well if I'd like to. I choose not to see them just because it's kind of, there's just a lot of stuff, but if I want to, I can show my working orders there. I mean, I can show my filled orders there, and that's everything that, you know, we just did and all the things I have on. So, and with all the quantities and everything else like that. And all these columns here, volume and delta, these columns are all configurable to anything you want. So if you want to see something like percent out of the money, probability of a touch, you know, you basically, you name it, you can set those columns up however you'd like to see it. I prefer not to show positions because I don't like it clogging up my page, but each person is a little bit different. And so this is kind of the beauty of the Tastyworks platform. If you've got an idea or you want to trade something, in this case, I just got short a little bit of gold. But let's say, for example, okay, well, that's cool. But I'm going to go over here and look at actual GC, which is the gold future. Now, the other nice thing about Tastyworks is we don't limit you to what you can trade, and we don't limit you to what you can trade in any type of account. So, for example, if you want to trade all these same trades in an IRA account, you can. We don't. You can trade naked calls in an IRA account, naked puts. You can do naked strangles, anything else like that. You can trade futures in an IRA account. You can trade futures options in an IRA account. You can basically do anything that you can do in a regular margin account. But the cool thing about the platform is you can trade everything from the same page. So here I'm looking at gold again. I'm going to go to 34 days out because the sweet spot's kind of 45 days out, but I'm going to go to 35 days out. I'm going to look at some of these out of the money gold options. Now, the one thing you should realize with gold is gold has what we call huge positive skew. So gold's currently trading at $1,400 on the nose, right? And the calls and the puts are about the same price. But if you go $40 out of the money to the 1440, they're $11.65 as the mid price. If you go $40 out to the puts, there's $7.40 as the mid price. So we call that huge skew. That means the puts are much cheaper than the calls in gold. So in gold, these are gold futures, by the way. I'm going to go out, and I'm going to go out to the, my preference is to go out just by, from all the research we've done, my preference is to go out to about, you kind of want to go out to, let's just say, around the 24 delta option. Let me just open up some more options. So I'm going to go out to about the 24 delta here, which is right at the 1450 call. And I'm going to sell the 1450 call, and I'm going to buy the 1455 call. And, oops, hold on one second. I had futures in here. I'm going to sell the 1450 and buy the 1455 call. And this is a call spread in gold. And mid price is 80 cents. Mid price is 90 cents. It's fluctuating back and forth. I'm going to try it for 80. I'll lock it in here at 80 and take a fill. And so so what I did is I just sold, and you can see how quickly this is. I just sold in using the gold futures. I sold a call spread in there and right at mid price. And so that's all. It just wanted to give you a quick, like, if you decide, hey, you know what, I'm going to trade gold futures as opposed to trading GLD, you can do that as well, right from the same platform, all the same trades, all the same spreads, and that's not kind of how, you know, kind of how neat it is. So a minute ago, we went in here, for example, and we sold. Let me just find something we just did a second ago. So a minute ago, we just sold these calls, just to give you an example, at 74 cents. Let's say I said, hey, you know what? I want to get out. So I just clicked opposite order, and I'll buy them back at 173 filled. So I just made a penny, but it cost me nothing to close that trade. I'm just doing this as an example. Normally I wouldn't, buy something and sell something and try to buy it back to make a penny. I just wanted to give you kind of an example here. Here's what you do. You can click on the filled order. You can go to opposite order. And like, for example, if I wanted to buy back this call spread, I could, but I wouldn't make any money on it. So I don't want to scratch it. So I'm not going to buy that back. And I could do the same thing, with this ratio spread if I wanted to. But at this point, I'm just going to hold those positions and we'll see what happens. I don't know. Maybe we'll make some money on it in a couple of days. I just want to give you kind of a quick little overview of what's happening. The other nice thing about taking this approach to trading and looking at markets this way is that as I'm watching gold, I can also watch the gold futures here, which almost no other platform allows you to do, which meaning as I'm trading GLD, I can watch the S&Ps here on the top level. I can watch the NASDAQ futures. I can see that this market right now is getting a little softer midday, and it's being led down by the Russell. I can also, create as many watch lists as I want. This watch list is just one of, literally, probably hundreds of watch lists that are built into the platform, and we don't limit you to anything. And you can make these if they're customized, you can make them as long as you want. And if they're your own, if they're ours from Tasty Trade, then they're kind of fixed, but you can use all our own watch lists. Like you can even have my own default watch list. It's on here. And one of the neat things we do on Tasty Trade, which no other firm does, we're extremely transparent. We're extremely transparent with ourselves and the people that work here. So, for example, the trades that I just made, you can choose to see. For example, all the trades that I made today. Here they are. So I'll show you every single trade. I've made about 60 trades already today, and you can scroll through every single trade that I've made today. They pop up almost instantly. So we kind of show, what we did, what the price was, what the IB rank was, what the description was, and these all come through on your mobile platform, or on your desktop platform. We don't show every customer. We only show people that work for us. So this is myself, and this is Pete Moldat, who's our futures expert. This is Mike from Mike and his Whiteboard. This is Brittany. This is Michael, one of our traders, and then there's a whole long list of people that are personalities with with our network. Anyway,
hey, Tom, I was going to say, great, and we're out of time now, but a really interesting presentation. It looks like a world-class platform. I like the, especially the curve look at in terms of helping develop the trade setup, and it's interesting. Like me, I do anywhere from 40 to 60 trades a day, but most of my traders don't understand that that's how you need to trade, is take a lot of shots. I know Mike had done a good video on law of large numbers. So we're going to wrap up. Let me, what's the call to action? How can they learn more? What should they do next?
Well,
and I apologize for the time. I could listen to you all day. You're a freaking genius, and I'm a big fan, but we've got our next presentation coming up. And
I completely understand. And I'd love to sit around and talk law of large numbers with you because it explains why we trade actively. But anybody that has any questions, you're more than welcome to reach out to me. I'm Tom at Tasty Trade. I answer all my own emails. So I'm Tom at tastytrade.com, or you can email support if you want to, or support at Tasty Trade or support at TastyWorks. But what I really love you to do is to check us out at tastytrade.com for the network, and tastyworks.com for our brokerage firm. You should check it out. It costs nothing to download the platform, and check it out. Just go to www.tastyworks.com and check out what we have.
All right. Well, thanks so much, Tom Sosnoff, and thank you so much for being here. I genuinely appreciate it. I learned more from you than anyone else on the YouTube channels, and you talk about volatility and risk management instead of magic chart patterns, and that's what traders need to understand. So thanks for being a star. I appreciate it.
Thank you so much. Thanks, everybody.
Thanks, all. All right. Well, Larry, you're up next.
Okay. Hey, let me see if I can figure this out.
You should have something.
Can you see my screen?
Looks brilliant. Hey, everybody. Here is Larry McMillan, the one, the only. And take it away, Larry. Glad to have you here. Thanks.
All right. Thanks, Ken. Yeah, we're going to just take a quick look this afternoon at the option indicators that we use, or the other indicators as well that I use to look at the broad market. Since we only have a half an hour, we're going to kind of zip through a few of these. Okay, just a quick word about our company. We started out as a research firm with publishing newsletters and data. We've since moved into money management. We're both a CTA and RAA, managing individual option accounts. And then we do a certain amount of option education and mentoring. You will be receiving a copy, or I should say you can get a copy of the PDF here by going to this URL, optionstrategist.com/summit. And also on that page, there's some discounts on some of our newsletters and things. So I look at four main indicators, and when we're talking about the broad market, the first and most important, of course, is the chart of the S&P 500 itself, because if your indicators are not agreeing with price movement is still king. We also look at equity-only put-call ratios and other put-call ratios. We look at market breadth, and we have an option already added and slant on that. And then we look at volatility, primarily VIX, but other forms of volatility as well. Just an important rule, oversold does not mean buy. Sometimes the market will get oversold and continue to fall for a long time like it did in December. Obviously, overbought does not mean sell either. So right now we're getting some overbought conditions because the market's gone up a long ways in just the last 13 trading days. But that doesn't mean sell. We wait for confirmed sell signals or buy signals from our indicators rather than just saying the market's overbought or oversold. So here's the chart of SPX, and it's pretty simple. There's not a whole lot going on here that you probably don't know about. First of all, we had the double tops up here at the back in September, and then same area tested again at around April 1st, and we fell back sharply from there. And when we fell back, we bottomed almost exactly at the same place we did in March and So you've got support down here at 27.20, 27.30, and on the upside, we've got these double tops. Now we just broke out yesterday above those, and we even went a little bit higher today, although we're pulling back a little right now. And so the question is, is the market just going to be fatigued at by having spent all this energy to get up to these double tops, or is it going to be able to go through? So I mean, obviously don't know the answer to that question, but it seems like this time it does have a chance to go through. And I guess one of the ways we'll really know is if this first support level here holds. It can pull back to this breakout level, which was around 2890 to 2900. If it holds there and then moves higher, that's fine. But any break of that 2900 level, I would think, would be signaling that this was a false upside breakout. I don't have these other charts, but if you look at some of the other charts, let's say the Dow, look at our 2-year chart, you can see quadruple highs there. And even on the S&P chart, the highs of February, late January 2018 are just below these levels. So the market has spent a lot of time trying to get through here and hasn't been able to do it yet. So what seems to happen is that every time it gets here, it's already spent all the energy that it has. And if you've been paying that much, too much attention here, you notice that this market is rallying on the hope of Fed rate cuts, which is not really exactly a very substantial thing to be rallying on. But as a technician, I really don't care exactly why it's rallying. So just to summarize, we've got this near-term important support at 2890 to 2900. The major support is well below that, but we're also dealing with a potential double top. But our take on the chart is that it's bullish as long as S&P stays above 2900. So there's another thing that we look at in terms of the S&P chart, and that's modified Bollinger Bands. John Bollinger invented the Bollinger Bands, and when he did, he needed to define volatility. So he quite logically defined it as a standard deviation of closing prices. That's great, but in the math world, they don't do that. They use a different definition. For example, in the Black-Scholes model, they use the definition as being the standard deviation of daily percentage price changes. And it gives you a different number. So since our volatilities are all very much related to Black-Scholes and everything we do in the option area, we really can't come up with a different volatility number that doesn't make any sense in terms of Black-Scholes. So we redrew the Bollinger Bands using that Black-Scholes definition of volatility. And we plot the plus and minus 3 sigma and 4 sigma bands. And there's been some very good trades over the last couple of years. I'll show you in a second. And right now, a new sell signal is setting up. So this is the same chart we just saw, but now it's got these bands on it. So this is the plus 4 sigma band. This one just inside is plus 3 sigma. On the downside here, the lower one is minus 4 sigma. And then the one just inside that is minus 3 sigma. So when it moves outside the band, as it did last December, and then it closes back up inside here, that's a buy signal. Obviously, that was a great buy signal. So the buys and sell signals are marked on this chart. Red letter in my nomenclature basically means a successful signal that we recommended the trade to our customers. We made money on it. The blue ones are ones that got stopped out for losses. So you can see that we had a sell signal here right at the end of April, and it was pretty quickly followed by a buy signal, which suffered through a little bit of a decline, but now has bounced back. So we're still in that one. But what's happened now is the market has moved above the plus 4 sigma band again, and we're setting up another sell signal. So we'll have another sell signal as soon as it closes below the plus 3 sigma band, which today would be 29.24. So I don't think we're going to get there today. That's 27 points lower than where we are, but it's possible. So over the next few days, that band will be crawling higher, and the sell signal will be, crawling higher as well. So, nothing is guaranteed, of course, but these have been pretty good signals over the years. And the gains, the losses are limited because we buy options, and the gains can be quite large, as you can see from some of those moves. All right, so enough for the S&P chart. The second thing we look at is put call ratios. And we look at the equity only put call ratios. Those are all stock options that trade. So we're not, in this case, we're not looking at futures options. We're not looking at index options. We're only looking at equity options, stock options. And put call ratios were invented by Marty Zweig back in the 1950s when he was getting the option volume out of the ads that were running for the broker dealers in those days. The put and call broker dealers ran ads in Barron's every Sunday. And he started to notice that when a lot of people were buying calls, the market soon topped out after that. And conversely, when a lot of people were buying puts, the market soon bottomed. So he realized it was a contra indicator and treats it accordingly. So what we're looking for is situations where there's too much put buying, in which case it means everyone else is bearish. We need to do something bullish. Conversely, if we see too much call buying, then everyone else is bullish and we want to do something bearish. Now, contrary trading is a little bit difficult. First of all, you're going against the crowd, which can be, a bit of a depressing thing, I guess. Everybody on TV is saying one thing, you're trying to do the other. For an example, go to Vegas and bet don't pass when the whole rest of the table is betting pass. They're all cheering at the time that you're booing, and vice versa. Anyways, so we're going to try to define what too much is. I'll get to that in a minute. So simplistically, the ratio is defined this way. Suppose we look at IBM at the end of the day, and we sum up the volume of all the puts that traded on IBM. Separately, we sum up the volume of all the calls that traded on IBM, and we divide the two. So it's the put-call ratio. I'm not sure why Marty puts in the numerator of the fraction, but he did. So when there's heavy put buying, that generates larger numbers from the fraction, meaning typically there would be heavy put buying in a down market. So when the stocks are going down, the put-call ratio would be going up. Conversely, since calls are in the denominator of the fraction, heavy call buying is going to generate lower ratios, and so heavy call buying would occur when the market. Kenny, trying to get me?
No, Harry Boxer just logged in, and hey, Harry, you're here. But carry on, Larry.
All right, thanks. So heavy put buying, heavy call buying would make the ratio go down while the market's going up. We keep a moving average 21 days, just in case there's something to Fibonacci, but you do need to smooth this out a little bit because they're pretty volatile. So in theory, this is how things should look. We should have a nice inverse symmetry between stock price movement and the put call ratio. For example, let's just say that the stock is declining. So all the while the stock is declining, traders are buying puts, and they're correct during the trend, but at the end they overstay their welcome. Everyone's loaded up on all the puts they can possibly buy here, and the put call ratio starts to fall. When that happens, that's a buy signal for the underlying stock, and then the stock should start to move higher until you get to this stage when everybody's so the ratio will go lower. Everybody has bought all the calls they want to buy, and therefore the stock should drop. So local maximums on the put call ratio chart are buy signals for the underlying stock, and local minimums on the put call ratio chart are sell signals for the stock. So here's the S&P 500. This is not current. This is the S&P 500 graph on top, and on the bottom is the equity only put call ratio, so all stock options that trade. You can see that they display the desired inverse symmetry most of the time, and so that's why we use the equity only put call ratio as a predictor of the broad market. So finally, here's the current chart, and you can see that the most recent thing we had on here was a local maximum right around the 1st of June, and that was a buy signal. Obviously, as we all know, the buy signal around the 1st of June was a pretty good buy signal. We had a sell signal right around the 1st of May, a local minimum on the chart, and again, pretty good. We had buy signals last December, a little bit premature one before that, and sell signals late last September, and vice versa. So pretty good trading tool, keeps us generally on the right side of the market. It's kind of slow moving, it's because it's a 21-day moving average. What I found a little bit interesting about this chart, earlier in the year, in February, this put call ratio had traded down to the lowest it had been in 4 years, and by just a few months later, it was the highest it had been since the financial crisis. So people went from extreme optimism in down here to the highest level of extreme pessimism in just a few months, and that's just what happens in the market. So this is a way of measuring that. Now, as computers have come along, we've been able to improve on this a little bit, and we can look at the weighted put-call ratio. Now we look at the dollars being spent on puts versus just the volume and the dollars being spent on calls. So what I do at the end of the day, every day, we take the closing option price and multiply it by the volume that traded that day. You could do it on a trade-by-trade basis. That just hogs up a lot of computer power that I'm not sure gets you any better answers. Anyways, so we make this calculation for every option, again, let's say an IBM, then we sum those up for all the puts, separately sum it up for all the calls, divide the two, and that's the weighted put-call ratio. Now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion, which in my opinion gives us a better trading tool. So here's the current chart. Not that it gave necessarily a lot of different signals in different places, but it can give them a more extreme. So you can see here a local maximum on the chart right around the 1st of June. That was a buy signal. Local minimum on the chart at May. That was a very low ratio there. The extremely high local maximum of the buy signal in December, etc. This ratio got so low in early 2018. It was the lowest it had been in 8 years. And then within just a few months, of course, was the highest that have been in 10 years. So similar thing. We look at both ratios because they both have their good points. But right now, both are on buy signals. So they gave buy signals in January, appropriately switched to sell signals in May. Now we're back on buy signals again. So this indicator is bullish. Well, there's another ratio that we look at, put-call ratio, called the total ratio. This one we include index options as well as the stock options. We don't get too many buy signals on this thing, about 1 or 2 per year. We invented this system 19 years ago. We've had, I believe, 31 trades. And we just finished a buy signal on this. A buy signal, it calls for a 100-point move in SPX. We got that on June 4th, and it took off, appropriately right after that. We also had another one in January. So we've had 2 this year already. That's kind of rare. It's going to take some major pessimism to set up another one of these. But we had major pessimism in December, and we had pretty much major pessimism in May. And both of those set up a total put-call ratio buy signal. So right now, this is a sidelined indicator, but it's something that we obviously report in all of our news letters and services. I just want to throw in, we don't have enough time here for me to go into what kind of options we're trading today, etc. Normally, I would address that in this type of a seminar, but I'll just say one thing. The guys I see on TV spread way too much. In real life, the only time you really want to do a bull spread or a bear spread is if the options are expensive. Otherwise, selling that option, that out of the money option, is cutting off your profit potential for no particular good reason other than just to lower your costs in the trade. But you can keep your costs in the trade the same by just doing fewer options to begin with. So when implied volatility is high on a historical basis, then yes, I can see doing bull or bear spreads. The rest of the time, I think you should concentrate on just trading. If you're trading speculatively, then speculate. You don't need to keep spreading all over the place, especially, on the guys on CNBC just spread every trade. It doesn't make any sense to me at all. Anyways, on to the third indicator. Before we do that, we do use the put-call ratios on individual charts. I'm just going to show you a couple. This is Boeing. We just got a recent buy signal in Boeing. It was under, of course, a lot of pressure after the accidents or the crashes. And now it broke out over some resistance here, accompanied by this buy signal. So we are long Boeing right now. You can see in the past, the last buy signal in there was pretty good. The sell signal was pretty good, and this sell signal is pretty good. Now, in Stock options, we only take the signals that occur at the extremes of the chart. So we're not taking this one or this one or this one, not even that one. We're looking for the very extremes of the chart before we take the signals. Another, just I'm going to show you just one more. This is cattle. We have a buy signal in place. What we're waiting for is a breakout from this triangle here. And, you know, it's closed by the August cattle futures above 107 would probably do it. If it breaks down, of course, we're not going to act on a buy signal, but there has been extreme pessimism building up in cattle futures. The line on the top there is a continuous chart of cattle. So, you know, we're watching that for potential trade there. Okay, now on to the third indicator, which is breadth. Breadth is simply the advances minus declines during a day. Mostly on the broad market, and we look at two data sets there. I'll talk about that in a second. You can keep your cumulative total, and you can also calculate an oscillator, which we do, define that as 90% of yesterday's oscillator value plus 10% of today's advances minus declines. So I mentioned two data sets. One is, of course, the New York Stock Exchange breadth. That's influenced by some things that aren't stocks, though. So we also look at stocks only breadth, and in our definition, stocks only breadth is all stocks that have listed options on them. There's a lot of those now, more than there are stocks in the New York Stock Exchange, actually. And so we calculate this oscillator daily, and when it gets above plus 200, the market is overbought. But remember, overbought doesn't mean sell. And when it gets below minus 400, the market is oversold. So you can see this goes back to 2013. So you can see in the last 6 years, the market's been overbought a lot more than it's been oversold. That makes sense because the market's been going up. But you can see that some of these oversold conditions were unbelievable. In fact, last December produced the most oversold reading on this oscillator in history. Also, last October was a big low, and even last February. So these are all 2018. We haven't had a true oversold reading here recently, but we have moved into overbought. In fact, when we came out of this oversold in December, we moved into one of the most overbought conditions that we've ever had in this indicator in January, extremely overbought. And in fact, it got so overbought that there are people who feel, and I'm not, you know, I can agree. I can see that the point. I don't really trade long term too much, but there are people who feel that when you get that much of a massive overbought condition, while it might have to relax and, you know, back off a little bit to correct, it's still it's a long-term positive indicator for the stock market. So we did back off a little bit in May. We got back in here. We didn't necessarily get a true buy signal out of that pull back because it didn't pull all the way back to minus 400. And now we move back into slightly overbought territory. When the market is breaking out to new highs, as it is right now, it's good to see this thing be overbought because it indicates the market is strong and broad and all those kind of things. So if we move out to new highs and this wasn't overbought, I would be concerned, but it is. And so the breadth indicators are bullish right now. And the oscillators gave buy signals on June 3rd and 4th. So the last thing we look at is volatility, and I want to spend a couple of minutes on that. The number one thing I think on the VIX chart is that you want to look at the trend of VIX. VIX is the CBOE's volatility index. It should be trending opposite to the market, or at least be trendless. Secondly, there are spike, when the VIX does make these spike peaks, and we have a trading system built around that, those are buy signals. So the trend is important, but if VIX is low and there is no trend, that's okay. That's not bearish. People say, oh, VIX is too low. I don't know what too low means anyways, but if VIX is low and just going sideways, that's not a problem. If VIX is low and begins to rise strongly, then you have a problem on your hands. So here's the current chart of VIX through last night. The B's here are the VIX spike peak buy signals according to the system I mentioned that we trade. And you can see that there, again, the same nomenclature we've used before, where a red B is a successful signal, a blue B is not. So there was a buy signal in early May, and while the market has rallied back to that level, I don't consider that a buy signal that was successful, because the market declined a lot after that. But you can see in general, it's a pretty good system. We have a real good track record with this system. And this is the 200-day moving average of VIX right here. Just want you to look at one thing. You can see that it's still rising. I find this a little bit, could be problematic. Long-term VIX trend is higher. Right now, VIX, usually by this time in the summer, in the last few years, VIX has been like 10, 11, 12. Right now, we're still bumping along up here, 14, 15. And, you know, there's a variety of reasons you could say, you know, traders got burned last year in the volatility squeeze, and, you know, whatever. It doesn't make any difference. But it is giving us a rising 200-day moving average of VIX. So VIX here is basically fairly low and going sideways. It's trendless, so that's okay for the stocks. But if VIX were to jump out here and go up above its 200-day moving average, I would start to be a little concerned about the trend of VIX, because a VIX that's trending up is bad news for the stock market. So right now, though, the VIX is trending sideways, so that's neutral to bullish, and, you know, overall the indicator is bullish, but a close above 17 would be something that you'd have to react to. Now, there's another thing that we look at with VIX, and that's where the futures are trading with respect to VIX, and where the CBOE volatility indices are trading. So right now, the futures are all trading at a small premium to VIX. The front month future is July right now, so VIX itself is this morning at 14.67, and the July futures at 16.05. So the futures are trading higher than VIX. As I said, we're trading at a premium to VIX. So that's a positive for the stock market. The term structure of the futures, that, in other words, that's the July future. The next future out in lines trading at like 16.70, but after that they kind of flatten out. So the term structure of the futures is kind of slightly upwards. The same thing is with the CBOE indices. The term structure is slightly upwards. The shortest term CBOE indice is the 9-day. And it's actually been flirting with going above VIX. It's not there right now, but it has been doing that. So this I consider to be mildly bullish. I've seen a lot steeper term structures and a lot more premium on the futures at other times in the past. That would make it more bullish, but right now it's mildly bullish. So let's review what we know. The S&P chart is bullish as long as it's above 2,900. The put-call ratios are bullish, the equity-only put-call ratios. The breadth oscillators gave buy signals in May, and they're still on those. They moved into overbought territory, but that's okay as long as the market's making new highs. VIX is bullish in that it's trendless. So it's trendless and it's below its 200-day moving average. So again, not a problem for stocks. The term structure is mildly bullish. We just saw that with the premium being small, but and the term structure is sloping slightly upwards. So overall, I mean, we have to be bullish because all of these things are on buy signals and none of them are on sell signals. The only pending sell signal we have is the modified Bollinger Band sell signal, and that actually has not taken place yet. VIX or SPX is going to have to drop. We'll have to drop 30 points this afternoon for that to happen. It doesn't seem likely. So, you know, next week, if it dropped 20 to 30 points over a period of a few days, it might give that sell signal. A couple other things, just things that we watch. New highs versus new lows, a very good early warning indicator. New lows started to exceed new highs both in January of 2018 and in September of 2018, and actually in late April of 2019. So this last decline in the market was tipped off a bit by this indicator. So we watch that. It's something to keep an eye on. Right now, it's quite bullish. This is just a chart of the how that looks going back, but you can see it went negative here, for example, last September when the market was still up at these levels, and then the market broke badly. And then one final thing, there is a negative divergence out there that's been out there for a long time. since July of 2018, and that is the big caps are outperforming the small caps by a wide margin. So IWM is the Russell 2000 ETF. So, and SPY is the S&P 500 ETF. So the S&P 500 is outperforming the Russell 2000 stocks massively, and that's not a good thing. Eventually, there's a price to pay for this. This decline last July and August set the table for the huge sell-off we had last fall. There was a recovery, but now we're back in another decline that started in March and persists to this day. And so, while we don't have any specific sell signals based on this, it's something that we pay attention to because it could become a problem later on.
All right. So, thanks. Yeah, good timing. We're out of time, so thanks.
Right. Okay, and just one thing, we have a day trading computerized system that anybody's interested, give us a call. And as I said, you can go there for our contact, or there's my email and other things. All right, Ken, back to you.
All right, well, thanks so much, Larry McMillan. You literally wrote the book on options, so it's a real pleasure to have you here. It's great having like the world's top people in one fast-paced event, so thanks so much.
Certainly.
Hey, Toni. All right, well, next up, we've got Toni Turner from ToniTurner.com. My first Amazon review ever was on Toni's excellent book, Beginner's Guide to Day Trading Online, back in the year 2000. And from Toni, I learned how to use ARMS indices and the VIX, or I'm sorry, the ARMS indice, the trend. Anyway, welcome to Toni Turner.
Hi, Ken. Can you hear me?
Yeah, coming through great.
Okay, great. Well, thank you so much for inviting me today. I really appreciate it. And I look forward to talking to everybody on this wonderful Friday when the Dow and the S&P 500 made new highs. We'll see if it can stay there or not. But welcome to everybody, and thank you, Ken, so much for putting this on. We really all appreciate it. Let me get my screen here to a little better place so we can look at this in a better manner. Okay, can everybody see that?
Yeah, looks great.
Okay, so thanks, Ken, and I'll get going right away. Let me get my pointer up here real quick. So hi, everybody. This is Toni Turner. Ken and I have known each other for about 200 years. way back in the day, so it's really good to be here with him. Today we're going to talk about how to bottom fish successfully, and I have to admit to you all that bottom fishing stocks and exchange traded funds is one of my very favorite trading strategies for a lot of reasons. Number one, it really takes in the old buy low, sell high, which may be an old saying, but it's certainly a fun thing to do. Too many of us sometimes get into markets like this and we end up buying high and selling low, and that's not at all good for our accounts or our self-esteem or anything else. So I love to do good bottom fishing trades, and part of me likes them because once I get in them, then you can use that trend reversal from a downtrend back to an uptrend, and there's a couple of easy ways to really hold that stock if it's a high quality stock, and we'll talk about that, and then just continue to hold it for the duration of the uptrend. And that is actually one way to make the most money in the stock market. Of course, the trick with that comes in is when you know when to sell it. And of course, getting in, we can all get into a stock if we have an account with a brokerage, but knowing when to get out is also one of the things I think Ken will agree with me is one of the tricks of the trade. Too many times we make money, make a good profit, and then lose it all back. So today we're going to talk about how to bottom fish successfully. Let's get started here. When we bottom fish, and I'm sure you've heard of it, we look for high quality, and say that over to yourself again, high quality, not necessarily little biotech stocks that can end up being dead money. Sometimes they move, sometimes they don't. or penny stocks. A lot of those now are cannabis stocks. Sometimes they move, sometimes they don't. I'm talking about high quality stocks here. Maybe they're Dow stocks, maybe they're S&P 500 stocks that have fallen, or maybe they're just, you know, strong stocks that are weak for a number of reasons. But high quality stocks or exchange traded funds that have fallen maybe 15 to 20% or even more off of their recent or 52-week highs. Now, and so that would be stocks that are trading up like this, call it a daily chart if you want, and then for whatever reason they start to fall. Now, this downtrend can be for a number of reasons. It can be because the market is falling. And that's not my favorite reason to buy a stock when the market's falling too. I actually want the market to be in a pretty positive mood. I want the SPY or the S&P 500 to be trading above the 50-day moving average if possible, but I can still do it even if the market's trading down. So you've got to think about when you look at a stock that's fallen 15, 20, 30% off its highs, ask yourself, is it due to the market? Is it due to the sector, like energy stocks have fallen recently because we had such a glut of supply of oil on the market? And now, of course, it's looking up a little bit, a lot of it on this news with Iran. Or is it simply company fundamentals? Sometimes a company, as you well know, because we've probably all been in them, got itself all tangled up. A lot of companies have been Amazoned. A lot of retail companies, we're going to look at a couple of those today. They were doing just fine till Amazon came along and everybody said, oh heck, I can buy that sweater in 2 seconds flat for less money on Amazon. Now, do I think that's going to stay like that forever? Not personally, no, I don't. But at any rate, a lot of good companies have fallen on that Amazon thing, or simply on company fundamentals. Some companies have fallen because of China tariffs, all kinds of reasons out there. Our goal is to single out the best ones, see where they are, and then plan a strategy to take advantage of when the uptrend starts again. So again, our goal is to identify signs that the stock's downtrend or even the ETF is about to end and may soon reverse into an uptrend, and then take advantage of that. So when it comes up in an uptrend, we enter here, and then if this stock continues in an uptrend, and I'll show you some that are did, then we take advantage of this move and certainly profit from it. Now, this is easier said than done right here, but it is not rocket science, and I'll show you a couple of ways to do it. So let's move on here. Now, our next slide, should there be a next slide here? There it is. Our next slide is a daily chart of the XLE. Of course, this is the Spider Energy ETF. Now, the XLE actually fell. This is a daily chart, and on this chart, the red line is the 20-day moving average. The green line is the 50-day moving average. The black line is the 200-day moving average. Now, the XLE fell pretty dramatically, and actually along with most other sectors and stocks, it fell dramatically from its highs up here, October 2018 highs at about 78. Price was about 78 up here. It fell 30%. That was bad. Down to its December lows, down to about $53.80 down here, December 26th. It also fell from its April highs up here at 68.55 down to its May 31st low. A lot of stocks fell during that time period to 58.77. That was a 14% drop, and that's the one that we're most familiar with, or at least the most recent one. So the XLE is, again, fell dramatically. Now, I admit, I like to trade oil stocks. Why? Because a lot of them have nice high volume on them, and a lot of them have very orderly patterns. I don't like to trade stocks, and I don't recommend them in Tony's Market Club that are all over the map all the time, that don't have the habit of making clear uptrends and even clear downtrends. And now, of course, downtrends are always more volatile than uptrends for the reason that fear is more, will take a stock or ETF down a whole lot faster than greed will take it up. Still in all, I like the orderliness of it. So a great way to keep track of sectors and stocks is, one way to do it is you can go to my website, toniturner.com. On the top toolbar, you'll see education. Click on education and you'll see sectors and stocks. And I give you the top 5 components in each of the sectors, the spider sectors. So that's one way that's a quick, free, easy way of looking at it. Let's go on here. So kind of look at this chart, kind of do a quick memorization of what it looks like, how the XLE came back up to its 200-day moving average in April, then fell again. Of course, a glut of supply on the market. Then we have the oil Iran problem here coming up this week. Now, let me see, hold on here. Let me see what happened here. It's not moving the way I want it to. Here we go, that's what I wanted. Now let's look at a chart of Hess Corporation. HES is the symbol, and this is one of the main components of the XLE. Now look how Hess fell here down to December 28 or 26, like most energy stocks did. And Hess came down to its lows here of about 37 and then started up. Now what I've done here is changed my moving averages. The red one is no longer on the chart. Now the kind of pink one is the 8-day moving average and the blue one is the 13-day. And what could become, of course, we don't know when we're watching this, but if we keep an eye on it, keep an eye on volume, look at the fact that HESS or HES is the symbol, this oil company moved into, as it's falling, you sit and watch it calmly as it moves down on the RSI below the overbought 30 line. The 30 line on the RSI is the overbought line, so it moves actually below it, not just to below it. You watch it, as I would like to say calmly, you watch the higher volume coming in as the sellers finally get exhausted and just sell, 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 sell. Then, as you see volume rise, I keep an eye on it. Now, some of you could buy here. I've been trading so long, I like to get a little more action to see what price is really going to do, because we might think this is very calm here in the market, but it wasn't calm when it was happening. Certainly the sentiment wasn't calm. So if you're a trader who's experienced and you absolutely know that you will put a protective stop under the potential lows here, if all you have to see is this chart up to this point, that's fine. I myself prefer to wait to see a little safer entry if there's such a thing. So we see Hess move up here. Volumes moving up. The RSI takes an early move up, starts in a little bullish diversion here. We have a higher low, which is one of my favorite things to see. What I like to use in a V-shaped recovery is the 8-day moving average crossing over the 13-day. Now that took a little while here. It took a couple more candles, but once I see price jump over the 8 and the 13, even though they're inverted here, that is about when I like to get in. Now, I don't get in with any illusions that the stock's going to keep going higher. Maybe it is, maybe it isn't. This is a pretty steep move here. But if you enter right when the 8 crosses the 13, and when price jumps over the 8 and 13, even though they're inverted here, that's okay. Then, as you can see, Hess rose up and made a mighty move and moved all the way up to almost $69, almost doubling in price. Not quite, but made a really sweet move here and then kept going straight. So if you watch the XLE, when the moves are coming down in a bottom fishing move, I mean, not the XLE, but the ETF that closely follows what your stock is in, then you can make trades like this. My stop on this trade once I enter here is a close below the 8-day moving average. I keep it really tight until I see if it can actually get over the 50-day moving average. Now, here's a tip for you. Let's go back real quick and look. Hess had support here, down here at about 35 when it made these lows and then started up. What I will do before I get into a trade is I will always look at a longer term chart, especially a bottom fishing trade, because I want to know that price has been there before and that traders, investors have bought it before, hopefully even and more especially the institutional guys and gals. I want to know their price, their support. So this is a monthly chart of Hess. You can see here, right here is the low we were looking at. You can see that all along back into 2006, Hess has had price support right around the 35 to 36 area. So that takes a little of the stress out. I still, of course, put my stop in, but that takes a little of the stress out. Heck yeah, every time Hess came here, came down to 35, 36, buyers stepped in and bought it. So that is a real good plan. Before you get into a long-term trade, please check to see if there's long-term support. And I do that before I get into every one or before I recommend it in the market club. Now, here's a trade, a bottom fishing trade, and here's the tip. You can turn a successful short-term trade into a trend trade. And that is one of my favorites. Although I day traded for several years and I enjoy day trading, as my life got busier, I was unable to sit all day long and watch my positions. And I'm sure all of you don't have that luxury either. So here is Scott's Miracle-Gro. Scott's Miracle-Gro came down here. As you know, it's a fertilizer company. It came down to its lows here of about 58 in December of 2018. Then word got out that they were also getting into the cannabis business. That'll do it, right? Although I know CGC's earnings didn't come out so well today. That's the big Canadian cannabis stock. But anyway, Scott's Miracle-Gro came down to these lows here. And we know that Scott's Miracle-Gro is not a baby biotech. It's not going to go away. This was a company that fell on its own company fundamentals. But then it finally, at long last, it came down to these lows here. And if you got in earlier here, you had a quick little trade, and then it fell back down again. For swing trades, I like stocks that walk up their 8-day moving average, and when they close below the 8-day, I exit. So this back here was actually a swing trade. But let's look at this low right here. You see the volume coming into it. That's what I want to see. I want to see people selling, 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 and then some of the volume coming in here is buying volume, obviously, because it flipped. We see the RSI going below the 30 line, meaning it's very oversold. We sit and watch patiently until it starts up and moves over the 8 and 13-day moving averages. Yes, they're still inverted. And then you say, self, I'm going to hold it as long as if it can keep going up and move above the 50-day moving average, then I may turn it into a trend trade. And that means basically that I'm going to hold it as long as it stays above the 50-day moving average. So it kept trading higher here. It finally climbed above the 50-day. Now, in this instance here, somebody's going to say, hey, Toni, it closed below the 8-day. I see that, but it didn't close below the 13-day, and that's another one of my criteria. So that's where I held it. Now, this is all going to be available to you in a program I'll tell you about at the end of our session here. But what you can do if the swing trade and off the V-shape is successful, you can, if you want, say, hey, I'm going to hold Scott's Miracle-Gro as long as it stays above its 50-day moving average. There's a few other tricks to it, but that's about it. And then look, Scott's Miracle-Gro, so far, we've got about a 40% gain here if you entered here up until today. So let's go on and look at another one here. We don't want to take too long, but there's two basic kinds, as far as I'm concerned, there's two basic kinds of bottom fishing plays. And that means there's two basic kinds of trend reversals. Now, we all know the market likes to do all crazy things. So I can't, and certainly not in a half hour, I can't go over many examples to show you different examples of bottom fishing plays. But basically, when stocks fall, they come down in a downtrend. Here you've got Nordstrom. You can see that this was a gentle downtrend, but certainly ended up being quite a nasty one money-wise. Price will come down in a downtrend, or like Hess came down in a downtrend a little more violently. And then they'll do one of two things. If it's a real nasty move down like it was in December for the market and a lot of stocks, a lot of times you'll see a little bit more of a V-shaped recovery. And obviously the form of a V. When it hits the lows here, then you check longer term charts and you see, yep, it had support there before. Always do that, weekly or monthly chart. And then you see it start coming up. Now remember, a lot of times stocks will make a base, and because stocks move up, down, and sideways, there's only 3 ways they can go. And because 2 of those ways are down and sideways, it has, if it moves up, it has about a 66%, 67% chance of falling back down or back down into its base. So many times bottom fishing classes will just say, well, the stock makes a base, and then when it moves up over resistance, you buy the breakout. Well, and that's good. And if it happens that way, it's fine. Do watch the volume. But a lot of times we'll also see the shape, the V shape that we saw in December, or we'll see a stock that maybe got Amazon. I'm going to call this L shape, like JW and Nordstrom did, and like it's trading right now. So again, we're looking at a stock here, JW, or it used to be JW Nordstrom, now it's Nordstrom Incorporated. I'm looking at it here. I told you in my description of this class that I would give you a couple of stocks to bottom fish, potentially, if it's something you like and something the market likes. So I'm doing this now. The other, where'd my cursor go? Come here, cursor. Where did I put it? Well, Tony, there it is. Again, these moves can be V-shaped. Sometimes they're L-shaped. And what this kind of shape would be, the L shape, is you watch it make a base, and then you watch it if it starts to move higher. And as I said before, like we said back here, yes, buying the breakout can be a good idea. At this point with this kind, I look for, and I talk about it in my program I'll tell you about in a minute, I do take 3 minutes, because after all, this is my money that I'm betting on these stocks, and I look at a company's fundamentals, and all I can tell you is if you just glance at the price to earnings ratio, and usually they're pretty low by the time a stock gets beaten up by 30%. If you look at that, does it pay a dividend? And usually the dividends, if it pays it, are pretty darn good when it gets down, if it's sold off 30% or more, and this one certainly has. Because if you add in that 2 extra minutes of looking at a company's fundamentals, it takes you really 2 minutes or less to say, what's the price to earnings ratio and does it pay a dividend? When stocks do that, And Nordstrom right now has a price to earnings ratio of 11, which is very nice, and it pays a dividend of 4.46%. So, and that's very nice in an atmosphere where it looks like the Fed's going to lower interest rates. So I'm looking at Nordstrom here. I've been watching it. It's trading right now. This was yesterday's chart, but it's trading about where it is right now, 33.21. Look at the volume that's come in here. Very nice volume compared to volume before. This tells me somebody's buying it. Also, we have Nordstrom is oversold. It has a bullish divergence here on the RSI, so I'm watching it. The 50-day moving average is coming down overhead, but far enough away I'm not going to worry about it at the moment. So is the 200-day moving average. So what I'm going to do this week, and what you can do too in the coming week, if the market's positive, is I'm going to watch Nordstrom and see if it can move up toward 33.50. And if it can, I'll probably add just a few shares. I'll scale into my portfolio and then see if and when it gets up to the 50-day, if it can move over that, then I'll add to the final rest of my position. And initially, of course, I'll use the 8 and 13-day moving averages as my stops. So that's one trade. We're running out of time here, so I want to quickly give you the second trade. This is another retail stock. This is Macy's, which of course is right next door to Nordstrom, maybe not quite as expensive in some of its clothing. Macy's is also gotten Amazon, and it came down from its highs back up here, back up around 40, 45 or more, all the way down, got cut in half, down to around 20. So it is now, and yes, all of these stocks have prior support. I've went and gone and checked them out. I'm looking right here at the volume that's come in here in the last month and a half, almost 2 months. As you can see, there's more volume coming in. Excuse me, the 20-day moving average accidentally got added to this chart, but that's what it is. The red line doesn't really matter. As you can see, Macy's came down to these lows here, made a little baby double bottom, little tiny baby thing, and then moved back up over, really, it's 8, it's 13, and it's 20-day moving average, and it's down here starting to rise up. It has really big, I think Macy's is the one that has pretty high. I know Nordstrom has a short float of about 23% because everybody was so down on it. So Macy's probably has a short float too. You can look it up. That means that if buyers come in, the shorts will have to cover, and that will push the stock higher. I'm watching Macy's here to see in the coming week if it can move above this 50-day moving average. So I'm looking to get it at 22.50 if it can do that. And then I'll use the 8 and 13 as my stops. So that is the two. These are not high moving tech stocks right now in this market. The way it is, I am going to stay a tiny bit more conservative, although you can still use these moving averages if you like to trade high momentum stocks. Right now, I'm staying a little more conservative with Macy's and Nordstrom. There's also another stock you can look at. I like some of the oil stocks now, as long as you've got a good stop on them. One of them is Holly Frontier. That looks pretty good right now. So anyway, after saying all that, know that bottom fishing can be an extremely high profit strategy to learn how to use. I have an online training for you called How to Bottom Fish Like a Pro. Now this goes into exact ways, exactly what to look for, how to buy low and sell high, how to earn 20, 30, 40, 50% or more on this kind of trading strategy. And again, the cool thing about what you'll learn is you'll learn how to keep your profits, whether it's a short-term trade from a tradable bottom or a longer-term trade for a company that really comes back. Keep your profits, people. Don't give them back. The summer months can be volatile because there's less volume out there. A lot of the big traders are in the Hamptons on vacation, so there's less volume. And that can make the market more volatile. And of course, we've got this problem with Iran and the tariffs and everything going on. So this is a great way to jump in to trades, make good profits, and know when to get out. Now, for you guys only, nobody else, and actually I've never done this before, so it's for you guys only. I am giving you, look at this link on your screen, https://toniturner.com/bottom fishing. I am giving you all today 30% discount, and that is for a limited time only, for how to bottom fish like a pro. And at checkout, you can use the code 30 uppercase letters HTBF, or how to bottom fish. So 30% for you all only, for a limited time offer. This will teach you exactly how to buy low, sell high, teach you the strategies, show you where to find the stocks to trade, and exactly how to enter, manage your risk, and when to sell. So Ken, I think I'm ending on time here.
The first person to do so. Thank you very much. I appreciate it. I know I could count on you. Brilliant ideas too. I like that 813 crossover. And I trade UWT for oil, and you're right. I bought 1050, sold 19, and now I'm back in. So brilliant thoughts. I highly recommend Toni Turner. She's one of the best people out there in the world to learn from, as are all of our presenters today. So thanks, Toni. Appreciate it.
Thank you, Ken. Thank you very much.
All right. Well, next up is Harry Boxer. Harry, I've got you twice here. Let me.
Hey, Ken, can you hear me?
Yeah, you're sounding great, man.
Okay,
hey,
good.
traders, we've got lots of prizes coming up later too. Let me see if the presenter screen comes up. Okay, Harry, so you should have a little pop-up box that says enable me for presentation. Hey, we got it. Good job, man. Hey, traders, you're in for a real treat. Harry Boxer is the other great breakout trader in the world, and he's a brilliant guy. I've learned a lot from him. He picks the same kind of charts I trade, which is great. So highly recommend Harry Boxer. And Harry, take it away, man.
Well, thanks, Ken, for having me, and thanks, everybody, for being here. My specialty is trading 1-minute intraday charts for day trades and 5 and 15-minute type charts for swing trades. We do upwards of a dozen to 15 trades a day in our site. Whenever we see something that has that kind of price volume surge, and gives us the kind of consolidation patterns that are setups for good day trades. I think Ken knows what I'm talking about because he trades the same way I do for the most part. At least that's what we learned about each other.
Yeah.
So today I'm going to show you an examples of stocks from today's trading, and also some swing trades that I put out recently to give you an idea of the kind of chart patterns and what I look for. I'm a big proponent of price and volume at the same time. I call it the price volume surge, coming out of certain consolidations and or continuation patterns, and recognizing those patterns so that we can catch big moves in the market, both intraday and on a swing basis. We're going to start off today with today's charts. Now here's a look at some of the charts from today. This morning, AXGT had some phenomenal news and exploded, and it went vertical. And when it pulled back on a falling wedge and started to break out, that's where we were looking at a day trade on this one at about the 6 3/4 range, and it quickly got up to 7.5 for a nice 75-cent trade, and it pulled back to retest. Exploded, trading was halted. I told my people any pullback would be a potential opportunity for a buy. It pulled back to 7 and exploded within minutes to 8 for a dollar trade there. Then a nice orderly retrace, held support again, broke out again. That move took you from about 7 1/4 to about 8.35, and you can see in the last 3 hours it's been moving sideways. But if you are trading certain patterns and looking for certain kind of patterns like falling wedges, we had 1, 2 falling wedges here and a falling channel there. Each of them, when they broke here, here, and here, were buy opportunities intraday for AXGT, and that's the kind of stuff we look for in techtrader.com. Overstock exploded today on some news, and when it pulled back, I told my people I thought this was a good little scalp trade. It pulled back to about 1063, and in about 15-20 minutes was trading over 12. A beautiful $1.35.40 trade, and you can see the rest of the day. When it broke down there, that's where we were stopped. I always put stops under the prior low. This prior low at 1150 triggered a stop right there. And then when I saw that bear flag, I said, it isn't done yet going down, which it didn't. And you can see that the stock meandered the rest of the day. It's trying to set up another base maybe for a late move, but this is a current chart up to the minute. We shall see. Another one was Crocs. Now, interesting chart on Crocs. Crocs exploded, pulled back, and formed a wedge. And I said, only when that stock breaks out would I be a buyer on it. This little flag was telltale sign. And the reason I think it was is because of the volume right there that popped it up to resistance and then formed the flag. Kind of felt that was going to break out. When it did break out, it ran up to resistance and backed off. Eventually got through and retested twice before extending and getting up to 1960 from my original point around 1910 for 50 cent scalp trade. That was all that was. But that was good enough for some of the traders in my room who like to do scalp trades. SE, well, this is not only a day trade, it's a swing trade. I want to point out where I showed everybody the swing. If you look back on a daily chart, you'll see a base pattern that exploded with a breakaway gap on monster volume back at the end of February. That's when I put a swing on it after it pulled back in this zone, in the 23 zone. It took several weeks of meandering and consolidating and forming a coil of sorts here. This is the pattern that I saw. It got me to get much more interested in it when it broke out. Now, it did pull back and consolidate for about 2, 3, 4 weeks more, but it finally made it up on a spike blowout, I believe, on earnings to 32, which, by the way, was my initial target, my second target being 35. And today, you'll see it exploded to 34.75, nearly reaching my second target. Quite frankly, when I see a chart like this, I think it has the possibilities of going on this angle all the way up to high 40s, even 50 on a swing trade. So this is far from being done. And if you look at today's unbalanced volume line, this is a new all-time high confirming the trend. On an intraday basis, we had a day trade on it as well today. So you can combine the swings with day trades at the same time. There's a lot of people who buy core positions and day trade around intraday patterns. For example, today it opened very quietly and then popped right there. At about 32.5 is when I noticed it. I didn't put a buy on it until it ran up, pulled back, formed the wedge, and then started to break out there around 33. From 33, it ramped quickly to 34.48 for $1.50 right there. And then took a couple hours to form a flag before it broke out yet again, eventually reaching all the way up to 34.75. And it may not be done, but this is the kind of pattern I look for. I look for pops, surges with volume, and then I look for real quiet periods where it gets either flag, a pennant, or coil, or something that indicates the potentiality of a continuation of the prior trend, this trend continuing there. And that's exactly what happened. Usually what happens at the tail end of every pattern, right when it gets very quiet and narrow and small little bars, the volume dissipates to what we call a low volume ebb. When you see that low volume ebb, and we saw it again here when it got quiet there before that move, this is an indication of a kind of a standoff between the buyers and sellers. And when the buyers take over, it usually runs. Here's a pop and a little 5-minute flag and another pop that extended this move. An interesting day trade that really didn't work that well, but is currently formulating a pattern that might, is Workhorse. Workhorse exploded and pulled back on a flag, and when it broke out again, it was a buy. We put a day trade on it about 245. It quickly ran to 257 at 58 for about 13 cents, but then got bombed, formed a falling wedge, broke out but could not get to the resistance from the prior high here. And you can see how it drifted lower. Now, falling wedges to me are one of my favorite patterns because eventually, when they get very quiet, they will spike up and break out. And that's exactly what happened in the last hour, as this thing ran from 235 to 249. And it's currently in a beautiful bull flag. I would not be surprised that between now and the close, if this stock doesn't break out and run to 255, 265, something of that nature. And it's an outside chance if the volume is huge, we can see 270 today. Keep an eye on this one for an intraday day trade scalp type play. CTLT. Now look at this this is a perfect chart. Breakaway gap, strong surge, and then a beautiful, what I would call a falling flag. Right to where the 50-period moving average is, you see the red dotted line? There's your breakout, there's your buy signal at about 51.65. An hour later, it's 53.30, and an hour after that, it's 54.05, 54.10. So it literally went up about 2.5 points for a nice 5-6% day trade at Keynote. GBTC is a stock we've been watching for a long time. I actually failed to put a swing on this one. I told everybody it looked like a swing. Take a look at the long-term declining channel for the Grayscale Bitcoin Trust. Now, you know that recently Bitcoin took off, and this trust took off with it. Take a look at the base. There's your breakaway gap with big volume, and then a pullback consolidation over a 4-week period that was basically, in my thinking, a bull consolidation. That broke out there, ran up to the top of the channel and my target, which was 11, pulled back and tested, ran up to secondary target at 12.5, and pulled back again and tested, creating a new rising channel bottom. The channel bottom is here, the parallel channel top is there. And I told my subscribers that I felt 16.5, 17 would be your next target. Well, it's on its way up another 83 cents or 6.5% today at 6.5 million. Now, that's the swing trade that it should have been. The day trade that was, we put out here today, when it popped, pulled back, formed the wedge, broke out and retested, forming a larger coil. This is what I would call a coil. And I call it a coil because the top's narrow, the bottom's narrow, and it gets to the apex of a pattern that I describe as a coil pattern. Breakout there, run up to the target there, retest and run up again, couldn't get through and then backed off. Nevertheless, this isn't dead yet. If you and by the way, one of the big things you'll see in my webinars that I do nonstop all day. All day, I do nonstop webinars all day. I show you, I show people my charts all day. I give updates and trend lines, and I will, for example, maybe change the angle of ascent. I may look at things from a different viewpoint, put support levels in, and something of that nature. So you can see right now that that is the resistance on GBTC, the Bitcoin Trust. And should this get about 1368, then I would have to put a parallel line off the channel bottom and give you a target around 14. And I believe that if GBTC breaks out this afternoon between now and the close, you may get a run up near 14. MRKR, beautiful pop, a big explosive move, and then a nice flag. Look how low the volume got and a low volume ebb right down there, and then exploded. Back then, field formed the wedge. You can't see it, but there's the wedge right there. Broke out of the wedge for a buy signal, ran up but couldn't get through a double top, and then rolled over. We did have a stop at about 780. Eventually, it got down to 725, and now it's recovered somewhat, but that is a trade that ended right there when it was stopped. Or if you got to the $8 range and you decided to sell it up there, which was a target. FRO frontline, the shipping stock, which I really don't like shipping stocks per se, but when you see that big breakaway gap and then a wedge and it breaks out there, there's a nice little scalp trade right there. The kind of stocks we follow all day. Crocs. Pop, coiled, broke out, ran up to resistance, couldn't get through, and finally broke through and tested twice, and it keeps going. I would not be shocked if Crocs, based on the current angle of ascent, makes a move up towards near 1990 to 20 at some point at the end of the day. There's your parallel channel. It's amazing to me how stocks will do this all day. They channel up, they channel down, they move sideways, they form coils, pennants, triangles, etc. So that's an example of a nice day trade. If you bought the first pop pullback that retested and held the opening pullback lows and then broke out there, you could have added some here with a tight stop and then added more when it broke out, or even there when it broke out again. So there's plenty of ideas that to go around. I just wanted to give you that as a look on some of the stocks that we trade, not only for day trades, but swing trade, but this is obviously some day trades. So let me show you some current swing trades that I have out. Now, we've had some big successful ones. Now, this is one that is an aerospace company that's been trending up, and then it broke out there. That was the swing when it broke out above that, and now it's flagging. I just recently put a swing on it because I believe it's going to get to 23, run to 25, 28, and 31. Those are my targets. With the stop pretty much under this pullback low, around 19 3/4, 1980, right through there. That's my stopping point. AQB is another. This little low price puppy can be best seen on an hourly chart. And you can see that the base that it formed here broke out with abandon, pulled back, and continues to look like this is what this wants to go materially higher. My targets are 4 and 5.5. Marijuana stock Tilray, although some of the marijuana stocks haven't done well, this looks pretty good. And the reason it looks good to me is because obviously they had the major run up. It came down in a massive decline from, I think it was 206, 300, all the way down to 30. So this lost 90% of its value. But this is called the double bottom with a V bottom type platform breakout flag. So when this broke out a few days ago and backed off, I put a swing on it. I like the look of this overall. I like the volume on up days. I like the low volume on pullbacks. It just feels to me, this is an hourly chart, right? Let's look at the daily, sorry. There you go. So it popped up and pulled back in a falling wedge. That wedge held support right there, went up, and now we have an inside positive day. If Tilray gets above 50.20, I'm looking for 54 and 62 going forward. And I think based on the long drop and the big pullback over a period of a year almost, or 9 months anyway, that this stock is ready for a turnaround and a retest of various resistance levels, of which 54 and 62 are your next major resistance levels for Tilray, for those of you interested in TLRY. Popular Chinese play was Huya when it came out. It exploded, came down in a falling pattern. And when I see IPOs do this, and then they break out, I often will put a swing on. We did that with OKTA and several others that really had out really well. This breakout was a buy signal. It wedged and broke out again there, ran up to resistance, and my target at 29.30 is a swing. I think this stock gets to 29 and then maybe even ramps all the way up to 40 at some point if we can take out 30 with real energy. That remains to be seen. But that is a current potential swing trade for my subscribers. A low price biotech stock, Pyrrhus. I love the look of any major biotech. By the way, you can see we had a beautiful breakaway gap there, and this was a swing for us from about 2.5 to about 9 at one point. You can see the big drop, the base, the breakout, and then this flag. When it broke out of the flag, I gave a buy signal. It's recently pulled back to retest. I'm fully convinced that this stock is moving higher, and the angle of ascent calls for 5.5 and 6.5. It's currently 440. I think this one has a good shot of making a move sometime in the near term, breaking out above resistance, and out of that pattern, you can see where support would be around 4. Another example of a current swing trade is something that, and the way I look at patterns is this. Anytime I see a long base and a major breakout, I look for the first pullback and the consolidation. When that took place and broke out, we put a swing on that one. It ran up and pulled back, had a nice little wedge, popped again and pulled back. This set is a nice setup in what I consider Elliott wave 1, 2, 3, and 4. The fifth wave, which may happen if it breaks out, could quickly spike up like it did here and here into that 4 3/4, 5 range. That's my target. Currently at 3, maybe a 50 to 75% type trade. ABM, a larger cap stock, American Building Maintenance was the name of the company. The reason I like this one is it looks like a massive left shoulder, head, right shoulder, inverted type head and shoulder with a rising neckline, which to me is a powerful pattern. When you get a parallel line on the shoulder line as well, that usually is indicative of a stock that wants to move higher. When it popped out and pulled back, I gave a buy signal on it. You can see that it's been consolidating, flagging, or wedging in this, coiling, whatever you want to call it, in this zone. Once we break out over 41, I'm looking for 45, and that's going to be key resistance at all-time highs. We get above that, it's going to be substantially higher, but it's a good setup for much more down the road. I like this little stock called Outlook Therapeutics. Anytime a stock gets creamed from 11 down to under $1 and then it explodes, pulls back in a falling wedge, I keep my eye on it. When this gets above 2.5, it's a buy. You can add above 3.5. The target's going to be 4.5, 6, and 9 again, if and when it gets the big volume we were looking for. We'll see. I like the Solar Group a lot, but Solar Edge in particular is a stock that I've liked for weeks and months. Put a swing on it when it broke the inverted head and shoulder type base with the breakaway gap, and then pulled back in a wedge around 50. It's currently trading, or was trading up to 61 nearly recently, and it's backing and filling. But I think the pattern setup is good for a retest of this level up in that 66 to 70 zone. That's where I think this one's headed. And I do want to point out that I don't go just long, I go short. There's a list that I publish every weekend called Box of Shorts. When you take a look at these charts, let's see how ugly they are. Breakdown, snapback, that's a good short right there on FN. GBX has been a short since it was up here at 43.66. You can see the 5-wave move down. I advise, although it is consolidating bearishly, They may go lower to cover at least half your position after a fifth wave has been achieved. GHDX looks like a massive top has been broken there with a breakaway gap to the downside and bouncing off support weekly, and with lousy technicals, I think this goes lower. CVS has been a short, literally, when it broke down here and snapped back in a wedge when it was trading at 83, the stock dropped to 52. EBS, a beautiful head and shoulders top right here, breakdown and a beautiful bear wedge right to the neckline. It was a short at 53, it dropped to 40, it's now bounced back to resistance in what looks like perhaps a rising wedge, but I would be careful, and the reason I'd be careful is completed a 1, 2, 3, 4, 5 wave move down and form what could be a deep bottom of the right-handed extension. So I've instructed my people to cover over 48 if it breaks out above that. If not, just stay short until it gets down into the mid to high 30s. Current new shorts that I recommended in the last couple of weeks. PCMI, which by the way, we recommended short here at 19 and it went down to 7. Has broken down here and formed a bear wedge, at which point I put another short out. I believe it was 29.5 in the area. It's down to 24.5 range. It looks to me like it's not done going down yet with a 1, 2, 3, 4. The fifth wave is yet to be completed, and it may see 20 or even in somewhere in the high teens before it's not too long on this one. Some more stocks on the short side that to me are about to collapse is Gravity, which broke its trend line, broke its 50-day moving average, just formed a bear consolidation, and he moved underneath, say, 56, and his stock could collapse into the 40s. LIVN broke down there, big bear wedge, another bear wedge. It's a 1, 2, 3, 4. I'm not so sure we're going to see one more wave down, but if we do, this could be mid-50s, early 74. Chinese stocks look terrible. I think the trade war has done a lot more damage to some of these stocks than most people think. When Sina in particular ran from 29 to 125 and then broke down and formed a flag here and a bear wedge there, I was very negative on it, and it continues lower, dropping from the high 80s to the high 30s, 50 points, and it's forming yet another bear flag. So you can see that it's the same technical patterns that I use and I look for work both long and short to just the opposite. The key to a trend change, folks, I want to point this out because most people don't know when a stock changes trend or how to identify it, is when a stock is moving up with high volume and moving down on low volume, that's bullish. When it starts to move down on heavy volume and rally on lower volume, that's the opposite. Bearish and often will dictate when the stock's about to turn down. IIN was a head and shoulder top, and when it broke down and snapped back, I put a short out at 48. It subsequently dropped to 21, and still it's like, doesn't look good at all. More Chinese stocks looking terrible. Look at this chart. But when it broke down there and formed the bear flag, right there is where I said this stock looks like a short at 43, and it went down to 13. Newell Brands broke down from the bear wedge, shorted. Another one, just they went from 31 to 13. So for me, it's more fun to go short because stocks drop twice as fast as they run up. Historically, the angle is twice as steep as when they angle up. The more people panic out than panic in. Anyway, so there's a drop, a sharp one, and a big bear flag, which ended up in another drop in a wedge and finally rolled over, literally from 22 to 6. Taylor Brands, maybe the worst chart on Wall Street, really. Massive top, broke right there, bear flag form, I said to go short, even at 14.75. It dropped to 5. It actually dropped to 4 and change. It looks like the company's going bankrupt. I don't know what to tell you, but bear flag, another one there, and another one there. This stock looks terrible. So there's a good smattering of some of the longs and short. Here's a couple more. Nasty trends. And this list is published every weekend at techtrader.com for anyone who wants to be short, just like I publish my top 30 list. And annually, I also publish a list for what I consider the top 30 stocks for the year. Part of my service includes intraday, day trade, and swing trade picks, nonstop updates, webinars, recommendations, and guidance. That's the key. People get guidance in my room, and they're always seeing the charts. And when I'm talking about the guidance, I tell them why, I show them where. I think it's an education to be in my room. And folks, you can come into my room for free for 2 weeks, no credit card necessary. Just sign up and come in. And a lot of people tell me that they have basically made enough money to cover a year's subscription in the first 2 free weeks. So I implore you to come in and visit us and see what basically the Tech Trader is all about. And in addition, if you want to get a little bit more education on my techniques, I wrote a book called Profitable Day in Swing Trading. There's the title. And it really gives you an idea. It's in layman's terms, and it shows you the kind of stuff I've been using for over 50 years now. I've been trading, I think it's 58 years since I've been 13, so you can tell how old I am. And Ken, I would like to find out if they have any questions. I know the other people didn't have any questions. I'm wondering if anyone has questions I can answer.
We probably don't have too much time for questions, but we do. Well, you did a brilliant job on your presentation, man. I was day trading Tilray yesterday, and I'm totally with you on it being the best of the pot stocks long. I was looking at Canopy Growth, but anyway, Harry Boxer, one of the smartest guys out there to learn from. His book, instant bestseller, and his room, thetechtrader.com, highly recommended, because he's a no BS straight shooter, knows his stuff cold, and brilliant guy to learn from. I always learn new stuff from you, Harry, so I want to say thanks, man.
You are more than welcome, and it's a pleasure to be here, and look forward to the next time.
Yeah, let me ask you a quick question, man. Here's something, in teaching like thousands of traders for 20 years, you get it, you pick the right kind of charts. I get it, we pick the right kind of charts, but most traders, when they ask me, Ken, can you pull up this chart and tell me what you think? They pick charts that are too choppy and too flat, and they don't have enough volatility. And volatility's, yeah, what's up with that?
The vast majority of people in my room, or newbies especially, will always pick stocks that are so overbought they think the momentum is going to continue to carry them forward, and they get sucked in at the top. It just happens amazing that people don't know when to buy a stock, and they certainly don't know when to sell. So my philosophy has always been, when you buy something, buy it in pieces, in tranches, at different levels. You can buy when a stock pulls back to support. If it breaks, you're out quickly with a small loss. You can buy more when it breaks out above the prior high. And you can, continue to do that and accumulate a position. But when you start to sell, you don't have to sell everything all at once, because the number one question I get over the last 20 years is, how do I stay in a trade? I always sell too soon. That's because you see a profit. As soon as it pulls back a few cents, you get nervous you're going to lose your profit, and you start to sell it. And next thing you know, it's just a normal pullback in an uptrend, and the stock continues higher. If you sold a piece of it, a third of it, a quarter of it, and then scaled it out as the stock went up, what's wrong with doing that? Why make a decision to sell everything all at once when you can sell little at a time, or sell at certain targets where there's certain resistance? Now, in my room, when I publish a buy alert, I give you where the target is, and usually give 2 targets, target 1 and target 2. I tell you where the support is, and I also tell you where to stop it. So every trade you have in my room, you're given the opportunity to know where the support is, where the resistance is, where you should be stopping it, and where you should be selling it. And uncannily, I hear from a lot of my subscribers that my targets are always very close to where stock peaks out. It's kind of interesting.
Yeah, and you're definitely one of the top people in the world to learn trading from. So, highly recommend. So, thanks, Harry, for being here, man. I appreciate it.
My pleasure, and I look forward to next time. Bye-bye.
Bye-bye. All right, traders. Next up, we've got Barry Burns. He's not logged in yet, so hopefully he will be able to join us soon. So, traders, let me ask you a quick question. Let me see. First of all, we're going to do some prize giveaways later in the session, so thanks for being here for that, and I appreciate it. Wanted to ask, what's one thing you guys like best about this format so far? And answer if I'd like to put testimonials on the site, so if I can put, I won't use your last name, but just your first name and last initial, like John D or whatever, but what's something that you like best so far about our presentations? Personally, I like that they're brief and to the point, and they're focused and good use of time. But if you would type in the answer, what do you like best about our format? Hey, Barry's here. Hey, Barry, how you doing, man? Dr. Barry Burns, he's got his YouTube channel you got to listen to. Let me turn control over to Barry. Barry Burns from TopDogTrading.com coming up next. But thanks, folks, for your post. Hey, Barry, so you should have a pop-up window that says Do you want to show your screen? And you should be good to go, man. Just checking. Barry, are you with us? While we're waiting for Barry, Barry, are you there?
Okay, I am here. Can you hear me now?
Yep, can't see your screen though, so you gotta click on the allow screen share button. It should be in the middle of your monitor, one of your monitors.
Yeah, one of my monitors, exactly. Yeah, I've got several of them here. So let me see which one it's looking at here. Oh, great. I just, let's see here, 1 second.
And traders, keep those comments coming while we're getting ready for Dr. Barry Burns. And seriously, watch his YouTube channel. He's really smart. I like watching his videos. I learned so much from all the presenters today. What I like best about today's event is we got, you know, really top-notch, top-quality people that actually know what they're talking about versus all the others out there in the industry. So I only invite truly the world's top traders, the people I've learned personally from and who I firmly believe can continue to benefit the trading industry. And there we go. We're in good shape. So Barry Burns from Top Dog Trading. And Barry, before we get started, we got a minute or so left. Traders, type in something that you like best about today's session. If it's okay if I put it on the website with your first name only. But I'd like to hear what you guys, and the reason I ask is this is my first time ever doing a multi-speaker event. I've held off because it's a lot of work, but you guys are all worth it, all the world's traders. I will be if everything works out fine, I will be posting the replay videos on my YouTube channel later today. So hopefully you'll be able to get there. It's a Trading Television is my YouTube channel. And we're going to give away prizes later today as well. So anyway, let's get on with it. And welcome to Barry Burns from www.topdogtrading.com. Barry, take it away, man. It's a pleasure to have you here.
All right. Thank you, Ken. And thank you for organizing this amazing event. I mean, seriously, the people that you got as presenters today is the top of the top of the top. So that says a lot about you that, you know, the best traders, the most well-known traders, top names here are actually willing to come on to something that you're sponsoring. Means they must respect you, and I know I respect you a lot, which is why I'm here. So congratulations, and you got
and back at you. Thanks, man. I appreciate it.
Oh well, you earned it. You earned it. And then also you get we all I guess contributed in getting a huge audience here today. So fantastic. Anyway, I know our time is limited, so all that aside, but you know, you deserve that acknowledgement. So I had to say that because it really, and I've done multi-speaker events myself, and you're right, man, there's so much work. There's so much work to getting everybody together, and so thank you for putting together this event. It's not easy. It is a heck of a lot of work. So, hello everybody. By the way, just so you know, I can't see anybody's questions, so don't think that I'm ignoring you. I am not. I just cannot visibly see your questions. So, and I've only got like 25 minutes anyway, so we're gonna zip through this, and I'm gonna stick to our schedule. Everybody else has, and I respect that of our other speakers, by the way, keeping us on schedule, which is always one of the challenges at these events. So there's my ugly mug right there. I'm Barry Burns, owner and founder of Top Dog Trading. As Ken said, I'm also the author of Trend Trading for Dummies. I received Reader's Choice Awards from Stocks and Commodities magazine. I've contributed to some other authors' books as well. And again, I don't want to go on about myself. You didn't come here to, you know, learn my bio, but here are some of the other companies that I've worked with, and obviously they vet me before they invite me to come in train their traders. So yeah, that's me. Okay. Oh, got to make our lawyers happy, because if our lawyers aren't happy, it's kind of like wives. Lawyers are like wives. If they aren't happy, then nobody's happy. So we got to keep. True. Yeah. But in all seriousness, I want you to think, and I'm not going to read through all of this, but I'm sure you don't want me to, but you should read it. And, you know, these disclaimers are on Ken's website or on my website, and you really should read it, because I don't want you to think of it as just legalese. This is really where your education begins. And the problem is these statements are so ubiquitous. They're all over the place. And so we develop kind of a legal disclaimer by blindness, if you will. And that's very unfortunate because you got to understand the regulators are really protecting us. And read this, even if you've read it before, read it again, pay attention, because this is here to protect you. This is the defense part of our game. And many people break these rules. They don't take it seriously. They think, oh, that's just legal, blah, 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 blah. No, it's not legal, blah, blah, blah. This is serious stuff. This has come out of the experience of many people losing money. So leverage it. Leverage it. Somebody did the homework for you and told you how most people lose money, and there it is. It's a gift. Today we're going to focus on cycles, and not by cycles, but we're going to focus on all kinds of different cycles. Now, you know, what's interesting is that a chart really has two dimensions, right? It's a two-dimensional object, literally. You got your time axis along the bottom, and you got your price axis along the right-hand side. And it's really strange to me because very few traders really give much attention to the time axis. Most are using the price axis, even if they're not aware of it, but they're thinking all about price, candlestick bars, you know, moving averages, indicators that are based on price. And there's nothing wrong with that. In fact, you should do that. You've got to do that. So I'm not diminishing that at all. I'm saying, yeah, keep doing that. But in addition, you need to very much also learn how to read time. You got to do both. It's not one or the other. It's both and. It's not either or. So, for example, common lament. Let's bring this down to practicality, where you live. So a lot of people say, oh, you know what? I got in, and then I got stopped out. And then after I got stopped out, operative word after. After is a time indication, right? After is a time word. And then they say, after I get stopped out, then the market made a big move in the original direction of my trade. So what's the problem there? And it's a common lament. Well, one of my mentors, Jason, who I trained with at the Chicago Mercantile Exchange, who is literally a floor trader at the CME, now the CME group, he said, Barry, retailers are often right, but at the wrong time. And that's exactly what's happening there. W.D. Gann, and measuring time and trading is nothing new. I didn't make it up. Okay, I studied under one of the greatest cycle analysis in the world, God rest his soul. And oh my gosh, it was a game changer. Now, I didn't study under W.D. Gann, but this stuff goes way beyond, way back to the days of yore. So old, the days of pre-yore, if you will. And W.D. Gann actually was very famous for measuring time on charts. And he said that trading all comes down to the confluence of time and price. A lot to be said about that, again, since that's the two dimensions we've got to work with. But he said of the two, time is actually more important than price, that they're not equally weighted. So whether you agree with that or not, I think we know that time is a very, very, very important and often neglected aspect of trading. So when we talk about cycles, we're talking about time. Now, there's many different kinds of cycles. So what are some of the types of cycles? Well, you got your seasonal or calendar cycles. So those who trade the stock market, really anything, even futures. I mean, futures were originally created around the agricultural markets where well, we go even beyond that. Farmers would say, okay, we're going to grow a crop. We'll sow in the spring, we'll reap in the fall. Okay, and that's a market. They would sell their goods, their foods, their whatevers. And now the problem was, okay, if they're growing crops and a disaster happens, a climate disaster, or might not even be climate, it could be a pestilence, could be insects, whatever, locusts, and destroy their crops. Okay, now they're in a world of trouble. So futures traders would come along and they said, we'll protect you against the unknown future. And we will speculate and we will pay you for your goods now in the spring. before before you harvest it. And the farmers are like, "What you talking about, Willis?" And that's literally what they said. And that's where it came from in the TV show. It came from agricultural workers. But in all seriousness, they said, yeah, now the thing is, if we're going to take that risk upon ourselves, we want to get paid for that. We're not just being, philanthropists here. So what we'll do is we'll pay you a little less than you normally would get, but we'll pay it for you now and mitigate your risk. We'll take the risk, but then we want to get paid more later. So you're going to overpay us, but it was a type of insurance, actually, is what it was. And so the farmers, many of them were like, cool, because if we can just lock in our profits, even if it's less, that is worth a lot to us. So we can, we've got a reliable source of consistent income. So that is a calendar cycle. That's kind of where it all began, actually. Volatility cycles. Volatility cycles are expansion, contraction cycles. If you want to really read about this, a good book. The book that introduced me to volatility cycles was The Master Swing Trader by Alan Farley. Really interesting book, and the beginning of that book is genius. Coupling and uncoupling cycles. This is where individual markets, stocks, equities, and so forth either trade in the same direction as its benchmark, the S&P 500 generally, or uncouple from it and trade differently than it. Up-down cycles, these are your oscillations in the market, which are measured by oscillator indicators, or if you're not using indicator, kind of the stair-step type pattern on price action. And then here's one that very few people talk about, the order chaos cycle. Very important. This goes back to the book Random Walk Down Wall Street, where basically it postulated that the whole market was chaos and was, well, not really chaos, but they didn't describe it that way. Chaos theories comes from a little different angle, but basically that it's unpredictable and the markets are efficient and therefore you can't really predict what's going to happen in the future. Well, that screws us as traders, because if you have no way, and I don't like to use the word predict, but if there's no way to establish a probability scenario for the future, then you can't make money. And that's pretty much what they said. Now, they have actually repositioned themselves a little bit after that. Now, let's talk about some of these. So seasonal cycles, I mentioned the agricultural markets. Again, the cycle is you sow in the spring, you reap in the fall, but there's other types of cycles. Retail. So a lot of retailers really make most of their money. Some of them make all their profits during the December holidays. And not all of them, but some of them do. So you got certain times of the year when, and they usually revolve around holidays, when retail really soars. It depends on what markets they're selling, what services they're selling. It could be, Valentine's Day. It could be other holidays, Thanksgiving, right? Go to the grocery store and try to get, turkey on Thanksgiving Day. Ain't going to happen, right? Probably not going to be any turkeys left. And if they are, they're not going to be pretty. So there's a cycle there of when turkeys sell and when they don't. Travel cycle. Obviously, the holidays, summer, so markets, companies that are involved in the travel industry, obviously they're going to have times of the year when they do very, very well. So now here's the key. These are just some of the calendar cycles. They're not always consistent, but you must be able to read a chart. And here's the tough thing. It all sounds easy and nice and cutesy and all that, but the temptation is then to trade the calendar, the annual calendar. And unfortunately, it's not that easy. You got to learn to read the chart of the market that you're trading. So what do I mean by that? So we use it as just one of the what I call energies. When I talk about energies, I'm talking about the energy of money. Money flowing in, money flowing out, the supply-demand imbalance. All right, so let's talk about volatility cycles now. I call these the ex-con kind of cycles. Expansion, contraction, that's an abbreviation for expansion, and contraction. So most people trade this backwards. Here's the deal. They will scan for high volatility markets to trade. Why? Because they say, well, I want to trade markets that are really moving, that are covering a wide range of price in a short period of time so that I get into an active market and get a great reward to risk ratio. Okay, here's what they don't realize. By the time a market shows up like that on a scan, there's got to be enough historical data to mathematically calculate, oh, we are in a high volatility market. But what it doesn't take into account is that high volatility and low volatility is a cycle. Markets expand and contract. So by the time enough time's gone by to calculate through the mathematical formula that, yep, we've got a high volatility market here. The danger is you could be getting that signal right before the contraction part of the cycle kicks in. And then the common lament of traders is, I scan for all these high volatility markets that are really moving and hauling patootie. And then as soon as I get in, then the volatility dies out. Why does that happen? My broker's trading against me. Market makers can see my stops and somehow they're taking me out. No, it's just that they're not aware of timing. This is a natural ebb and flow of the market, expansion and contraction. Now, I like to trade inside of contraction. So I actually like to scan for low volatility markets, searching for high volatility trades. Seems backwards, but that's because I know that that's the cycle. And I'm going to look to get in at the end of a low volatility cycle to get in the beginning of a high volatility cycle. So in practical terms, these are things like triangles, Bollinger Band squeezes, wedges, etc. So this is the general concept of a volatility cycle. Wide expansion, okay, price makes a big range of movement in a short period of time, and that creates this rectangle that we can draw. Low volatility, narrow range market over a longer period of time. And so this is an intraday chart. This is a meta pattern. Doesn't happen every day, but it's a meta pattern. High volatility to low volatility to high volatility. And we will see this within even most trading days. And, that's pretty much based around people doing what? Going to lunch, right? Now, of course, most people know this pattern. And so guess what? Doesn't work as good. In fact, one of the best trades I've got is to actually look for big moves during lunch. Does it happen every day? Absolutely not. Does it happen once a week? Yeah, it does. In fact, when I was in Chicago, I remember we were down there on the floor, and there you could see the traders physically. We're looking at a chart. We were seeing what's behind the chart, and seeing the people trading. And you'd see the whales leaving. Whales meaning the large, institutional traders, the big traders, and they'd leave for lunch. And I'd say, okay, well, let's go to lunch, Jason. And he'd like, nope. I'm like, what do you mean? I'm hungry, dude. Let's go. And let's get our quinoa and our broccoli sprouts. Now, I'm not a vegetarian and I don't like that stuff. But anyway, and he'd say, nope, wait. We wait there for like 15, 20 minutes. And sure enough, the whales would return about once a week. And they would come in and they trade during lunch. Why? Because they didn't want people following them. They knew people would follow their trades. And so they would literally leave the floor, wait for a while. I don't know what they were doing out there. Well, maybe they're having a 1 martini lunch. I don't know. And they'd come back and then they'd start trading during lunchtime. I'm like, are you serious? He says, yep, we got them. And, we call that hooking your wagon to the whales. Hooking your wagon to the whales. Now, another type of cycle is the coupling and uncoupling cycle. So the market, and there's many different types of benchmarks you can use, but probably the most commonly used one is the S&P 500. So if we're going to look at trading various sectors, industries, today with ETFs, you can trade countries, currencies, commodities, interest rates, all these wonderful things. And that's an awesome opportunity. I'll tell you, we have more opportunity today than we ever have had in trading. In a way, trading is, hate to ever use the word easy when it comes to trading, but we have more opportunities, I'll say that. And so we watch these individual sectors, industries, countries, currencies, commodities, interest rates, etc. And we look to see, are they moving with the benchmark or are they moving against the benchmark? And these cycles, where sometimes they'll align and trade with them. I remember back in the olden days, I was taught that, bonds and equity markets always trade against each other, always trade opposite. That's not true. Sometimes they do, sometimes they don't. Sometimes they couple and they trade exactly like each other. Other times they uncouple. And that provides key opportunities. What I like to do is I like to watch for markets that are coupled. They're trading just like the S&P. And then they uncouple early. By the way, early is the operative word in pretty much everything with trading. The earlier you can get in, the better. Because by the time everything is seen and known and obvious, everybody sees it and opportunity's gone. It's too late. It's like, you know, watching the cover of Time magazine for the latest, greatest, you know, biotech company or whatever. Okay, too late. If you're getting in now, man, the big money has been made. So here what we do is we watch for the relative strength to outperform the S&P 500. And this is one way to attempt to outperform the benchmark of the S&P 500, which, by the way, very few, even professional traders do. And then one of the most common cycles, the one that probably most people think about when they think of cycles, is just up-down cycles. So your oscillations, your higher highs, your higher lows, that kind of thing. In this type of situation, the market tends to make bigger price moves and spend more time, there's that word again, time, in the direction of the trade. And then on the retracements, make smaller price moves and spend less time against the trade. So what I like to do is I always trade these kind of oscillation cycles, these highs and lows. But I love to trade them in combination with volatility cycles, and in combination with order chaos cycles, and in combination with calendar cycles. Because the up-down cycles, higher highs, higher lows, that's a more precision entry. These other type of cycles are more broad sweeping. So here's an example of up-down cycles. So you got your low, more time going up, more price going up. Retracement in a trend, less time going down, and less price range going down. So one of the best tools I ever created to do this was my cycle indicator. Now, this is not a proprietary indicator that I have, you know, calculated, made. It's I'm lousy at math, so I'm not that smart, and I'm a lousy programmer too. So on both ends, yeah, I'm not going to create an indicator. What I've really done is modified an existing indicator that's pretty much in everybody's charts. And this thing really is amazing. When you trade it, now, it does identify every single cycle high and every single cycle low. Some of them we can trade. We don't trade them all. I'm not going to say that. We don't. I'm not going to be unrealistic here. But there are certain times where patterns are created that give us the final high or the final low. So this is, for me, just, I mean, it's the scalpel to my trading. It's the scalpel. It's the thing that I use for precision entries. And I'll be happy to give that along with a free webinar for everybody here who's interested. Finally, I want to just cover the order chaos cycle, because this is one that most people are not familiar with, and it's one that you really need to know about, because this is not taught very often, and it's a shame. So again, we've talked about the market being a random walk, and Random Walk Down Wall Street, the famous book. Some people really adhere to that philosophy. They say the market's completely efficient and it's a total random walk and everything is already priced into the market. Therefore, basically, you know, trading is a fool's errand. There's another school of thought, and this kind of comes out of your Gann market theory people and so forth, where they will say, oh, the market is perfectly orderly and perfectly predictable. And, you know, I've even heard people say that they predicted the price of, you know, a certain market 12 years into the future, the exact day and the exact price. Okay, I don't really believe that stuff. But anyway, there's people who say that. So I looked into both of these because these two schools totally contradict each other, right? So I studied them both. And I'll tell you, as I was reading the books, I was kind of drinking the Kool-Aid, because they're both very convincing arguments. They make very convincing arguments. And so I'm like, wait a minute, how can I be convinced of both of these arguments when they totally contradict each other? So I meditated on it a bit, gave it a lot of thought, and over time, I had an epiphany. I'm like, you know what? They're both true, but at different times, at different times. So what's that mean? There's a cycle. Timing is cycles. This is why overtrading is the cardinal sin. And it was my cardinal sin. Of all the problems I've had with trading, and I've had plenty, the biggest problem I had was overtrading. Because I assumed that I should be able to catch every cycle low and every cycle high and every move in the market. And that's just not true. You can't. Nobody can. Nobody does. So you need to know that. So there's certain times when the market is orderly, and again, I don't like to use the word predictable, but I would rather say that we do have a high probability scenario for trading. And brothers and sisters, that's not most of the time. That is not most of the time. Most of the time, in my opinion at least, the market is pretty much a random walk in the sense of there's no predictable, there's no statistical edge for you to have at that time. And so what our goal is to wait for those times, those cycles, when the market is creating an orderly pattern, when we can have not a certainty, but we can have a probability that puts the odds on our side, and we wait. And this is the challenging part. We got to wait. And so trading takes a lot of patience. You know, it's almost like chess. And guess what? Chess is not real popular. Why? Because most people consider it boring. I remember one of my mentors actually said, profitable trading. That's what he said. Profitable trading is boring. I'm like, I don't want to hear that. That's not what I want to hear. It didn't matter. What I really wanted to hear was the truth, and he told me the truth. And I'm telling you the truth right now. Most of the time, we wait. Professional traders trade a lot less frequently than you probably think we do. And it's because of this order chaos cycle. So to solve this problem, and I don't have too much time left, so I'm not going to spend too much time on this, but there is a solution that I've come up with. And the obvious question that this begs is, well, how do we establish when we are in an orderly market? And my answer is I wait for the alignment of 5 energies of money flow. All right. So those 5 energies are very simply trend, direction. Number 2, momentum. That's the strength of the trend, weak trend or strong trend. Number 3, cycles. Now here I'm talking about the actual oscillations, higher highs, higher lows. And then support resistance levels, very important. And then number 5, looking at multiple time frames. So looking at the higher time frame to confirm the shorter time frame. The key is these are uncorrelated energies. And that's what gives you a statistical probability is the word uncorrelated. In other words, we're not talking about just putting 5 indicators on a chart. When they all align, then you trade. No. It's much more strategic than that. Okay, so when you measure these energies, you've got something that's rule-based. You've got something that's objective. And we use indicators because indicators are literally math equations. There's nothing magical about them. They're mathematical. Because they're mathematical, they're objective and rule-based. You know, if you put in to a calculator 2 plus 2, you're going to get 4. If I plug into a calculator 2 plus 2, I'm going to get 4. If Ken types in 2 plus 2 into a calculator, he's going to get 4. So that's what an indicator literally is. It's a math equation. You got to understand that that's what it is and take it for what it is. And when you understand that and learn to read it accurately, and don't think it's something magical or just follow some wiggles or squiggles on it, but really deep dive into what does this math equation mean and when is it giving me a meaningful signal, then you can use them effectively. They don't make you money. Indicators just give us a value of the energy of money flow that they were designed for. That's why you've got to really understand what it's designed for. That's objective, rule-based, and duplicable. So at each point, I just ask how many of those 5 energies are aligned. I literally give it a score of 1 to 5. Higher the score, the higher the probability of the trade. It's like taking each trade to court. We need 5 independent witnesses. I'll tell you, I got people who sent me charts that said, hey, I created my own 5 energy method. They got 5 indicators on there. Oh, that's great. Sorry, but they're all trend indicators. So you didn't dive deep enough. The dollars are in the details. So they have really, with these 5 indicators that are all trend indicators, they have a 1 energy method measured with 5 instruments. That, my friend, would be like putting 5 speedometers on the dashboard of your car. No bueno, not going to be too helpful. Okay, so I don't have time to go through these charts here right now. I got to make room for our next speaker here, but everything works sometimes. Nothing works all the time. With your money on the line, you want to know, will it work this time? This time meaning the time you're going to take a trade. So I wait for the alignment of the 5 uncorrelated energies to put the odds on your side. And this is it. I can describe it in one sentence. Early in the new trend, that is a strong trend, which means velocity of orders and weight of orders, which refers to volume. At the right time, that's where oscillations come in, with support or resistance at your back, and then we confirm it with the higher time frame. It's robust because, well, we're just measuring money flow. And all markets basically work on the same thing as an auction place. I learned this from market profile studies, and I don't really use market profile techniques very much, although I think they're great. But I think their analysis of why markets work is spot on, which is basically an auction place. So when you measure money flow, buying, selling, supply, demand, that's going to work for any market. It's going to work for any time frame relative to that time frame. It's simple, it's objective, and basically we're counting to 5. And I know everyone here can count to 5. So let me just finish up here. If you have any questions, you know, I had to zip through this pretty fast and just give a quick overview. There's my email address, barry@topdogtrading.com. Feel free to send me an email, ask any questions you might have about this presentation or anything else, anything with regard to price action, volume, my workout routine, whatever. And I do have a freebie for you. I kind of dropped the ball a little bit. I didn't come with anything to sell. So I know you're really disappointed that I don't have anything to sell to you today, but I do have a freebie for you, and I'm going to give you one of my courses. And this course is all about how pros trade differently than amateurs. What are the distinctions? So it's 5 days of professional trading videos. Now, don't let 5 days scare you away. It's really only 5 20-minute videos. So you go through them real fast. I just like to spread it out so you don't get overwhelmed. And you can actually go through them anytime you want. At the end of each video is an interactive quiz so that we can make sure you get the information. We call these feedback loops in training. So it's much like sports psychology. I think the best kind of psychology for trading is sports psychology, by the way. That's the psychology I teach my students. And so we do these feedback loops with the interactive quizzes. You'll experience that in the course. I'm also going to make this very practical for you. Not just going to give you theory. In my course, I'm actually going to give you an actual trade strategy called the rubber band trade. I want you to take that trade. I want you to make money with it for free. And then if you want to use that money to buy, you know, so courses or whatever, mine or somebody else's, then that's great. Or give it to your favorite charity. And then the cycle indicator that I mentioned, I'm going to give that to you as well. So you get it all by just going to this very complicated email, Top Dog Trading, or a website, topdogtrading.com/free. And we just hit 11:30 here in good old La La Land. So yeah, topdogtrading.com/free. Just sign up there and you get everything above. My gift to you. So, whew, had to race through that, Ken, but I made it. So,
good job, Dan.
Yeah, thanks.
Yeah, I like your way of thinking. You got a good disciplined way of thinking about the market, and it comes out in your YouTube videos and your courses too. So, thanks, Dr. Barry Burns at topdogtrading.com/free, and I appreciate it, man. Thanks so much for being here.
Thank you, Ken. Much appreciated.
All right. Well, next up, we've got my longtime colleague, Steve Nison from candlecharts.com. I'm turning presentation control over to him. He is the only person in the world you should learn candlesticks from. Everyone else screws it up. Steve's the original and the best. I've known Steve for what's going on 17 years now. So anyway, Steve Nison from www.candlecharts.com, the world's top and only expert you should learn candle trading from. So thanks, Steve, for being here. Really appreciate it.
My pleasure, Ken. Okay, so we'll keep this for 30 minutes or less. So what we're going to focus on here is East and West, finding the highest probability trades. And that's because, as shown in this slide here, the more signals that we have, either candles, I abbreviate candlesticks as candles, or Western technicals, or a combination of both, that converge at the same level, the more likely reversal. We have to remember that the power of the candlestick charts is that they give you very often early reversal signals ahead of traditional Western technical techniques. And that means we're kind of going against the current trend. So we want the probability in our most likely on our side with the highest percentages. And so what we do here in our own trading is not only look for candlestick signals, but also if they're confirming a Western signal. Now I'm going to show you some of my favorite Western tools. You'll have your own. Let's say you like looking at, MACD or stochastics or whatever. Continue using your favorite Western tools, and then do as the Japanese do. Get the final confirmation with candlesticks. And I really call that the multiplier effect, where a Nison candle signal, and the reason we call it a Nison candle signal is because, as Ken mentioned, there's a lot of information out there about candlesticks, but unfortunately, a lot of it is incorrect. So when you come to us for education about candles, you know you're getting the right information. But essentially, when a candle signal confirms another indicator. So here, for example, is my workbench, and you can see all the Japanese books that I've had translated, or at least some of them. I've had at least 15 translated over the years. And in the middle, with the typewritten pages, those are all the translation that my translator made for me. All those pages there are all the translated material. And what's interesting is, as I mentioned before, first of all, what the Japanese do is they use Western technicals and then get the final trigger with candlesticks. In fact, this is a picture of one of the books that I had translated. And you can see that I had to put little tags on there because I don't speak Japanese. But what's interesting is you can see the author of this book had moving averages on there, dual moving averages. And at least a third of each of these books, although they focused on candlesticks, they all had our Western technicals. And until I revealed candlesticks back in the 80s, we were essentially just using Western technicals without the added insights of Japanese candlesticks. So let me show you some of my favorite indicators, Western indicators, that I use for combination of candles. We'll discuss horizontal trend lines, what I call change in polarity, crack and snap, and falling off the roof. And it's important to realize that, and I'm sure you do, but you may not have thought deeply about this, because candlesticks, it's like a bar chart. It shows the price. Remember, a candlestick line, a candlestick signal, every session is made of open, high, low, and close. What's a bar chart made of? Open, high, low, and close. So you're using exactly the same data as you would with a bar chart, but the candles give you so much more visual information about who's winning the battle of the bulls and the bears. And with that in mind, the reason the candles have replaced bar charts everywhere in Europe and America since I revealed the candlesticks, you go to any charting package, any charting system online, brokerage firm, they all use candlesticks now. And the reason for that is because the candles, when you know how to use them correctly, reveal the force of the current move. And we could use this last aspect to really gauge whether support or resistance potentially could be broken. Now, remember, whatever I talk about now can be used in all markets and time frames, and even options. Really important as implied volatility is with option trading. The number one factor is trend, and if you could tell when a trend is changing or if there's a potential breakout, you're going to be in a great position to take advantage of a trade. So one of our challenges is identifying if support or resistance is stronger or weaker. And how do we do this using candlesticks? Well, let me show you an example. And I call this candle confirmation of support or resistance. It's a way of analyzing the candle signal to see if there's a diminution, a lessening of force at support or resistance. So let me show you. Okay, here we have two scenarios. Scenario 1, scenario 2. And the red dashed line is a resistance area. And I'm sure you're familiar, but just to remind you, a white or green candlestick, depending on your charting package, means that the close is up here and the opening is over here. A black real body is the opening is over here and the close is over here. And of course, we have the shadows, the high of the session and the bottom of the shadow is the low of the session. And again, this could be for a 5-minute chart. It could be for a daily chart. It could be weekly. It doesn't matter. So in both scenarios, the market is at resistance. But where do you think the market is more likely to reverse? Okay, is it scenario 1 or scenario 2? And it's both, stalling at a resistance area, but at scenario 1, we have relatively strong sessions. Yeah, over here in session 2 in the white real body, we do have a bit of an upper shadow, but essentially the market is closing fairly strong. I'd be nervous setting up a bear trade over here because we're not getting candle confirmation, as opposed to if we have one of these candlestick signals at resistance in scenario 2, we can see visually, and it doesn't have to be, 4 signals. It could be this one. It could be this one over here, which is actually a shooting star in an uptrend. It could be this one here or this one here. We could see that the force of the move, the bears are coming in very aggressively, or the bulls are stepping back as the market gets to resistance. So with this, to me, the candle lines in scenario 2 would be giving me a little bit more candle confirmation of the market potentially stalling. So let's look at an example here. And by the way, there's no markets, and no time frames, because I really want to underscore the universality of candles. This could be an equity market, it could be an index, it could be Forex. It really doesn't matter. So I don't want you to be distracted by the market, what it is. So here, this long black real body at the extreme right, the market's at support, right? But is there any signs the bears are losing steam? No. So we have some strong downside momentum, and in fact, right after that, the market continued lower. Okay. Now here we have market, and the red lines over here is at a resistance area. We have a couple of doji. By the way, the plural of doji are doji. Okay, is the market at resistance at this long white candle? Again, depending on your charting package, it could be green. It doesn't matter what color what color you have. The red candles could be black. The black candles could be red. Is the market at resistance? Yes. Second question, are there any signs the bulls are losing force on the tall white candle? All together now? No. Let's look at the next 2 sessions. Is the market at resistance? The same answer. All together now? Yes. Next question. These are 2 questions you should ask every time the market's at support or resistance. Is the market at support or resistance? And then the second one, a la the candles, are there any signs, that is candlestick signals, the bulls are losing force? And the answer is yes. This is why even individual candlestick lines are very, very valuable. You get a sense of the force of the momentum, whether it's strong momentum or weakening momentum. Okay, here we have a bullish engulfing pattern where a white candle wraps around a black real body, confirming support. This is one of my favorite ways of using candles. I like looking at horizontal support or resistance. And if we get a candlestick signal confirming that, there's a high probability of a reversal. And theoretically also, the stronger the support. Many candlestick signals, like engulfing patterns and so forth, can be used as support or resistance. And here we have that candlestick signal actually confirming a prior support area. Now here, this is going back a few years. I remember this one. This is a long-term, this actually was a monthly chart, I think. And there was major resistance. And one of the things I like doing, and ignore the 44 here, I think this was a page number or something I had in one of my prior sessions. One of the things, I go back as far as necessary to look at support or resistance. So here, the market, this was the pound dollar. I remember this really well. And the market was at resistance. I had to go back to a monthly chart, going back years and years, when it was around 2, a long time ago. And there was major resistance in the 2 area. Now, a monthly chart doesn't do me much good, but what I'll always do is look at a longer term perspective. Now that we have major resistance going back years and years on the chart here at 2, I then move that resistance line onto a daily chart. So that's what I did here. Long-term resistance that was based on the monthly chart going back many years, threw it onto the daily chart to see if I get any candlestick signals confirming that resistance. Here we have a long white real body. Same question as before. Is the market at resistance? Yes. Are there any turning signals yet? No. What we're getting here, almost like a doji with the opening and closing of the same. Okay. The small wheel body, the long upper and lower shadows are showing you the market is like totally confused. And then we get the bearish confirmation with the black real body. And this is actually what happened after. So the concept of this is, go back as far as necessary to look at support or resistance. You could have a daily chart, but you may have to go back years to look at support or resistance. And then see if you're getting on your time frame. You may be looking at, you may trade intraday. And in that case, your longer term time frame may be a daily chart. So throw your daily support or resistance onto your intraday chart and see if you get any reversals with the candles. Okay, great extra short. Okay, so one of my favorite techniques, I named this change of polarity. I wanted to come up with a catchy term. It's a standard Western charting technique. Essentially, multiple times, as long as you test support 2 times, once support is broken, okay, it becomes potential resistance. And okay, so let's say you bought a support here, you're really happy. Okay, congratulations, you bought a support. Now you're getting really nervous. So what's going to happen is the buyers at that support area who are losing money are going to be thrilled to break even. Okay, so the buyers here, all the buyers around here, once the market breaks, will become sellers here. They may view it like this, just praying and pulling for the market to come up. And this works both ways. Support, once broken, becomes resistance. Resistance, once broken, becomes support. And this is actually a great way to trade breakouts. If you have a multi-tested resistance area, the market breaks out, it gets at a stop under the prior resistance area. So let's look at some examples here. So this is an intraday chart, right? A little bullish engulfing pattern, okay? And we have a resistance area here, okay? Market broke above resistance. Now remember, as long as it's tested twice, and it was actually tested 1, 2, 3 times. I sometimes make a little zone over here. Once the market gets above it, that old resistance becomes support. See what happened? This is one of my favorite techniques. Use it over and over again. Okay, and then we have a little shooting star, and the next day a black real body, actually completing a bearish engulfing pattern. Okay, so long-term support, once broken, becomes new resistance. Let me go back there again. Okay. Same thing here, change of polarity. Okay, now don't look through a well. The Japanese have a saying, don't look through a well to see the sky, because you're only going to see a portion of the sky. So we have a series of piercing patterns at 1, 2, 3, 4, and 5. A piercing pattern, just to refresh your memory, is a white real body that gets deeply into a black real body, doesn't quite wrap around it. And piercing patterns at 1, 2, and 3 in the red look fine, but why would we trade differently with piercing patterns 4 and 5 compared with piercing patterns 1 and 2? And think about what I just talked about, right? Change of polarity. Okay. So as I mentioned, sometimes I'll make a zone. Okay, as I did over here. So as long as they're near each other, this zone becomes potential resistance. So although we have piercing patterns at 4 and 5, always think about the risk reward of a trade. There are lots of concepts I won't have time to get into. I'll mention our Express class where I talk a lot about risk reward. But think about the risk reward of this. If you buy in this piercing pattern, you're long here and your stop is under the low of the piercing pattern and your target is up here, that is first resistance. Is that a good risk reward? Obviously not. Same thing at the piercing pattern at 5. So always look at candle signals through the prism of where support or resistance, and always think about risk reward. Normally we won't do a trade unless the risk reward is at least 1 to 2. Okay, same thing here. Multi-tested support. Once broken, becomes a resistance area. And what happens is, this is one of my other favorite techniques, crack and snap. Essentially what happens is that the market breaks under support, cracks under support. Now, remember what we were talking about with the change of polarity. This old support should become resistance. If the market gets back above it, then it's actually a potential buy signal, because very often the market will get to the most recent high, and you could set a protective stop at the low of the move, called the crack and snap. So right over here, we have a multi-tested support area. See how it got under support on the session and then got back above it. As soon as it gets back above it intra-session, you can think about buying it. Keep a stop here, and your target is the most recent high. The opposite of the crack and snap is the falling off the roof. And the Japanese say, let him climb the roof and then take away the ladder. Look out below. So it's the opposite. You have resistance, the market gets above it, can't hold above the resistance area, and then gets down here. Okay, under here, you can think about selling it, maybe liquidating a long position or going short. Keep a stop at the high here, and your target is down over here. So here's a classic falling off the roof, multi-tested resistance. Market gets above it, get above it and close above it, and then the next session get below it, or it could be in one session. So as soon as it gets above it and then gets down under it, you could short it, keep a stop here, and the target is the most recent low. Great strategy. And we had a little bullish engulfing pattern, but why wouldn't we buy in this bullish engulfing pattern? The falling window. Window is resistance. Okay, right over here, falling off the roof. Okay, market got above resistance, see over here and over here. And we have something called Nison Candle Scanner. It's software that picks up my favorite candle signals. So that's why it's highlighted here with a little down arrow. So the market gets above the resistance, can't hold above it, and gets down to our target, the most recent low. And why wasn't this window my first support area? Usually the window support over here, because the market closed under it already. So once the support is broken, we no longer need to look at the window. I like also looking at volume. So here we have a nice breakout, and it's a white real body. The problem is, look at the volume. Very light volume breakout. So I'd be a little suspicious. And then look what happens. We get a series of doji. And for a while, this, the market is trying to hold in, but the doji, the small real bodies, rounding top, really warning that the breakout wasn't substantial. If we have a breakout, one, I want to see a white real body. Two, I want to see high volume on that breakout, which we did not get here. Now here's a bullish engulfing pattern in green. And look at that, the white real body is more volume than the black real body. This is what we like to see. Here, and this is great. A window is one of my favorite candlestick signals. We have a rising window. Okay, in the West, we call it a gap, rising gap. And it's a big volume rising window. So the market, the bottom of the window is the major support. Yes, it did break under it, but it didn't close under the rising window. As long as the rising window holds on a close, it's still a valid support area. So when you do have a rising or falling window, look at the volume to confirm the potential strength of the support area. Here we have a high volume doji. It's a little bit more advanced, but a high volume doji is telling us that the only way that it could be high volume is if there's a lot of sellers here, right? But what's the only thing to keep this from being a long black real body if there are a lot of sellers with high volume? A lot of buyers, right? So high volume doji are very good often as as reversal signals, top or bottoms. We did have a falling window here, but the next day the market closed under it. But this is a high volume doji. As many sellers was trying to pummel the market, enough buyers came in to keep the market unchanged from the prior opening. Here's a cartoon I had made up. I can't tell you how far it is, but I do know it's that way. And this is one of the reasons, this cartoon references one of the reasons I always use Western technicals also with candles. I've been using Western technicals since 1974. So I've been using them. I revealed the candles in the late 80s. So, I've been using Western technicals longer than candles. But candles don't give price targets. So one of the ways that I get price targets there are many ways. You know, we'd use standard, Western technical techniques, but one of my favorites is a box range, where we have what the Japanese call box range, essentially a trading range where we have multi-tested support and multi-tested resistance. So here we have a box range. What I'll do is take the height of the box, whichever way it breaks out, and theoretically, once it breaks under the support, the old support should come resistance, change of polarity. You take the height of the box, and if it breaks out to the downside, this is your target. You take that height of the box, you subtract it from the breakdown. On the flip side is if it breaks to the upside, you take the height of the box, and that becomes your target. And what's nice about trades like this is the multi-tested resistance. If the market breaks above it, you have your stop under the breakout, because you know the old resistance should be support, and you have a price target. So let me show you some examples here. So here we have a weekly chart, right? And again, candles work in all time frames. So a weekly chart, the box range, as long as it's tested, resistance and support is tested 2 times. So the box in this case was $8.50. Okay, I remember this because this is pretty recent. I forgot what market it was. Yeah, you can see this was back in June. You take the height of the box range. And what's nice about this, I started to say, is once it broke above the resistance, this market, because it was recent, was in uncharted territory. So how do you get a price target? You buy in the breakout, but where do you look for resistance? You take the $8.50, add it, you get that $8.50. Doesn't mean that's going to be the first resistance. Look, we had a shooting star here, but coincidentally, because it doesn't happen that often, right at the target, look what we got on the weekly. A doji, a long upper shadow doji, okay? Here we have a nice example of candles for early reversals. We have a series of bullish engulfing patterns. We have a descending triangle. Now with Western technicals, like a descending triangle, the breakout comes in this session over here, right? 128, 130. This happens to be a Forex market. But look, we got early reversals. We had a bullish engulfing pattern here. We got a bullish engulfing pattern here. So even if you waited for the third and bullish engulfing pattern, which is a great trade because look at all the engulfing patterns down here confirming support. Let's say you bought on the close 126 here. You got in some 200 pips earlier than you would have with waiting for the breakout. And then what you do when the market breaks out, then use standard Western chart techniques. You take the height of the ascending triangle from the base to the peak of the triangle. You add that and you get a target. And you can see here, target doesn't mean resistance. A target means a minimum target. So this is a nice example of using the early reversal signals of candles and using Western technicals for a measured move. Some of you may use MACD. Again, there's so many Western technicals I don't have time to get into. Use your favorite tools, but here's a nice example again. We've got a reversal over here with the bearish engulfing pattern in the shooting star a bit earlier than we would have with waiting for the MACD crossover. You know, we're looking at making an extra couple of bucks by using the candlestick reversal signals. And this is generally going to be true with Western signals because think about it, the Western signals are lagging indicators. You know, think about the moving averages and the MACD and so forth. But the candles will give you reversal signals in 1, 2, or 3 sessions. So just wanted to give you a broad overview. It's much more education. I wanted to give you some of my favorite Western charting techniques, the change of polarity, candle signals confirming support or resistance, the crack and snap, and so forth. And let me show you our special that we're running. The Express class, essentially what this is a 2-day seminar condensed down to about 3.5 hours. It can be used in any market, in any time frame. It has printable handouts, chart challenges, and we even provide you with a quiz to make sure that you're learning what you need to learn. Normally it's $149, the regular price is $295. On our website it's $149. But if you use this code until this weekend, Express50, it'll only be $99. We do have a money back guarantee, and you will have instant access. It's down, you know, streaming. You'll have instant access, and it's a great way to get my favorite candle signals and Western signals. And let me do the raffle. I promised a raffle, and then I'll show this again. And oh, I can't see who. Oh, here we go. I'm arbitrarily going to pick an attendee. Okay, if I can see them. Okay.
I don't know
Yeah,
if you
probably
can
not.
see them or not.
Yeah, just pick somebody, Ken.
Okay.
Yeah.
Okay, James
Don't-
S.
James.
James S.
Okay, James. Okay, as long as you don't say Ken C. All right.
Okay, all right.
All right, James. Email paul@CalhounTrust.com. We will give you a free express class video. Again, this is streaming. It's instant access. So go to CalhounTrust.com/express. And be sure, unless you want to pay $149 for this, be sure to use Express 50 to get your $50 off, if I did my math correctly. And that will only be valid until this weekend. So thank you so much for joining me. And I'm impressed with myself. I did keep it under 30 minutes. Ken, you're a good taskmaster. So I didn't want to get you upset.
No, you guys are great. Yeah.
Yeah.
It's cheering out loud here. What do you guys think? Really kicked ass, this whole event, right? I'm really thrilled to see all these brilliant people presenting their best and brightest ideas in a very short time frame, 30 minutes. It's hard to ask people who've got, decades of experience to compress into 30 minutes, but everybody did a brilliant job, and I'm really honored and pleased to have, the participation of some of genuinely the world's top traders here. So thanks, everybody. I appreciate it. I'm going to do a prize giveaway, then I will try and present myself. I've been having technical issue on my end, so I may need to reboot the computer or stop it. So if for any reason I can't present, I will record it myself and put it in the. Here's something I want you guys to take note of is my YouTube channel. It's youtube.com/trading television. So that's where the video replay will be, youtube.com/trading television. So let me see if I can turn control over to me. But it's been a great event. Thank you so much to all of you for being here. Yeah, it's not working. I've been having technical issues with the interface. Let me try and get restarted here. But thanks. If you guys would please type in a testimonial or a comment or something you like best about today's event, and I will try and get my session loaded up here. Please be patient with me. I appreciate it. For some reason, GoToWebinar has been having a challenge with my big trading system here, so I've been switching presenters using my laptop, but not getting any love here on my end. But thanks to all for being here. We're going to look at some day trading charts and time and sales and breakout patterns. We're also going to look at, if you want, swing trading charts. So, but in the meantime, please type in one thing that you like best about today's session. It really turned out great, right? The time did not drag. The time went by. If anything, I wish we had more time with all the presenters, but I think we had really good tips and strategies from a lot of really super smart people, and I personally learned from all of them, so I'm deeply grateful. Honestly, I've learned from all these people over the years, and they're all really good people to learn from. Notice, please, it's a diametrically opposed thing to these pop and drop, cheap $3 stock momentum things that these inexperienced people talk about. The one thing that everyone had in common was clear signals and volatility, right? Volatility was one of the main themes of our event today. So that's one thing that we're going to look at. Let me give away 3 of my $497 15-hour trade mastery coaching courses before I try and close this and get my GoToWebinar working on my main computer here. Volatility has been one of the key themes. Everybody answer, what is the 3-letter index or indicator that is usually used to identify or capture volatility? I know Larry McMillan talks a lot about it. All right, wow, we got a lot of you. All right, Morale P, you've got it. You win one of the courses. Chad W, you've got it too. Chad W, our next $497 winner. And Chris Z, I just randomly picked. I've got all these answers scrolling by, so those 3 are the ones that'll get the Trade Mastery coaching course. And it used to be like a $1,295 webinar series. Now it's a downloadable course, and I sell it all week long at $4.97 at the Trade Mastery site. Okay, next question. Amazon gift certificate number 1. I'm just going to do little $5 because I don't want to break the bank here, but stay tuned for my presentation. But I want to give away some prizes, and if I'm able to come back, we will give away additional prizes too. But first, Amazon gift certificate. Let's see, what's a good quiz question? Okay, here's one. I'll give gift certificates to 2 random people. What? This is a tough one for the sharp, attentive people in the bunch. But what was the value of the 2 crossover, the MACD crossover indicators that Toni Turner presented for crossover? What were the 2 numbers that she gave? Ray B, you've got it. Javier, you've got it. Wow, you guys are freaking genius. You guys all remembered. I personally wouldn't have remembered if I was an attendee, but you guys got it. Yeah, it's 8 and 13. Wow. Let's see. Linda K, you've got it. And I'll give away one more. Ted K, you've got it. So I will be sending out $5 gift certificates to everybody who is there. Let's see. We got so many folks here. I wanted to thank all of you for being here. Let me try and restart this this thing so I can get my presentation underway for you guys too. And if I can get back here, we will continue with more prizes and more giveaways. But I sincerely appreciate all of my presenters for being here, and all of you folks, all 1,200 of you, for making it a big, successful, first ever multi-speaker event. So now let me try and restart this within Task Manager, and hopefully I'll be right back. All right, I am back. Let me ask, can all of you see my screen okay? All right, cool. Okay, thanks, guys and ladies. I've got a good presentation for you. A big thanks to Paul from Steve's company for reminding me it's always a good idea to do audience interaction. How many of you are day traders? How many are swing traders? And how many of you do a little bit of both? I'm just curious. Type in the word day, swing, or both. And if you guys are all swing traders, I will modify my presentation on the fly to look at swings, but a lot of both. Okay, yeah, that's what I've been finding. And asking traders worldwide, most people do both. So that's good. Just remember, you can always turn a winning day trade into a swing trade. I like to, like Harry Boxer said brilliantly, he's so smart. All these people are so genius. It's great. Partial out, do position sizing, like my colleague Van Tharp teaches. Anyway, we're going to look at how to day trade momentum gaps and breakouts. And I'm going to officially get started right now, 5 minutes after. So that's me. I'm a real freaking trader. I did 5,500 trades. Barry Burns said the #1 sin is over trading, and he is right. I've got the knocks to show it, but I've also got the winning trades. Anyway, I am a real trader. I did 5,500 trades. Fidelity even cut my commission half because I trade so much, right? Quick tip there. I'm only paying $2.95 a side, which is still more than I pay in IB, but anyway, I did 5,500 trades in this year alone. Now, the most important thing that Tom Sosnoff said today, in my humble opinion, the most important thing is a brilliant platform, but from a trading standpoint, the most important thing he said, oh, here's another good quiz question. I like giving away stuff. From Larry McMillan, 1 month of the Daily Strategist, his 2-time per day comprehensive coverage of all aspects of the options market, including recommendations and data analysis, value $195. And I will randomly pick from those of you, I will give this away to let me, whoever can tell me, here's the quick question. What's the range of trades that Tom Sosnoff said that he makes? And he does, he actually showed his real trades just like I do. He says trade small, trade often. I say trade wide, not deep, same thing. What's the range of the number of trades that he did? And limit one prize per person. Smart people, you guys are getting it again, but well, very few people got it. Alexandra, A-L-E-K-S-A-N-D is how your name starts. You're one of our, you win the prize, 60, between 40 and 60. I don't know what this breaks down into, and I'm not going to do the math, even though I used to be a corporate statistician for the Ford Motor Company. I'm a numbers gearhead, but anyway, that's how many trades I did as of the 17th in my live real money trading account, paying slightly north of 20 grand in commissions. Now, your jaw would drop if I told you my P&L on those trades, but I'm not here to brag. I'm here to just show you I really trade. So anyway, I've been all over the place. I've done as much as 4.9 million in actual trades in a given year. You guys voted me #1 author in the entire planet for stocks and commodities. I'm beyond thrilled for that. Role model for my daughter, right? It's a good thing. I was rated #1 and 2 Reader's Choice Awards. Barry Burns also ranks highly in Reader's Choice. Anyway, I've got a special offer, and I'm not going to talk much about that. Let's get into it. What are some good breakout patterns? One of the things that I like doing is buying previous strength. If something is gapped up and it ran up and it's sold down and starts to bounce, the bounces can be good, but it's better to look for wider range instruments. Okay, so for example, Kern, I made the call in my live room today at 30.7. That was my long call for my traders. It ran all the way up to 36. As I mentioned in one of my dozens of stocks and commodities articles, the most important thing on this chart is not any of this. Heresy, what's he talking about? That is secondary. What's the most important? $5 Amazon certificate to the first person who can tell me what's the most important set of data on this chart. I hear crickets chirping. Al, you got it, man. Al S. Al, you got it. Range. The range. Volume is second. This is the ace. This is the king. This is the queen. All right. Typically, traders think about things in terms of price action and with confirming volume. That's critical. That's why I called this at 30.7, because the volume spiked. And many of our guest speakers today mentioned the point of that. And that's it's a concept actually originally pioneered by my colleague Leibovich, who talked about volume reversals, VR strategy, Mark Leibovich, really nice guy. Anyway, the point is when you see volume on a reversal, that's a confirmation that you may get some buyers. I called this long for my members. They were thrilled. I said, go long over 30.7, young man. And boom, 6-point winner, flawless victory. Let's zoom in on the handicap here for those at home. 30.7, long trigger, ran all the way up here. Now, what I will always do is sell into resistance. So I will often sell into a cut pattern. I usually close out a trade at a cut pattern or a whole number. Selling at the 0.9s or 0.8s under whole numbers is a good way to trade. But it all starts with, as the trader wisely mentioned, with the trading range. When you're scanning for what the heck is worth trading in the first place, it's generally not going to be the pop and drop momentum stocks like this. That's likely to get you in trouble. I mean, seriously, how many of you out there could have traded this profitably? Okay, I'm a baller day trader. I've traded tens of millions of dollars worth of stocks in the ETFs over the years, and I could not make money out of this chart, okay? Only trade when you've got an edge. An edge, a trader's edge, is when you're at the corners, like Toni had mentioned, say an oversold RSI signal, or at the very edge of a trading range. That's where you look for pivots or reversals, like this guy. Look at all the money one could make in this. Knowing when to get out is half the battle, though, so I always trade with trailing stops. Now, IPOs like work. An absolutely horrible chart to trade, but yet I called it long for my traders this morning at 38.7, and I said to sell 39.7. We didn't get the exact top, but my live real-time call at tradingopen.com was that when it was down here, and the reason is because of support here. Previous support provided current support. So when it was touching down here, I said, guys, we're going to hit it long if it goes 38.7. And as it ran up here, I was telling everyone, sell it all right here near 39.7. Okay, so for another prize is right. From Larry McMillan, we could do, let's say, a month of daily volume alerts. His daily newsletter recommending speculative situations based on heavy option volume, corporate events, breakouts, value $99. Why did I say to sell 39.7 or 39.8? It was right here. Why would I have sold that? And again, it was skyrocketing up. There's no sign that this would occur, but I told everybody, I said, watch this. It's going to drop like a frickin' rock once it tags the top. But why did I say sell 39.7? It was a 1-point winner for my live room members today. But why the heck would I say that? Al, you got it, but only one prize per person. But if I could give away, I would. But you are correct. You're the only person who's correct so far. Previous resistance is one answer, but those of you who studied me know that there's a better answer than the obvious. Market makers, I used to do vague seminars all the time, and I'd have institutional traders and market makers come in. You can look at my video testimonials. The guy said he learned more in a single weekend than he did in 10 years on Wall Street. I think he was being kind, but he seemed sincere. He seemed like a straight shooter, straight shooter guy. Previous resistance is going to get you killed, right? Traders will often buy a breakout above resistance and then get faked out. There's always going to be false breakouts and high frequency trading algos and market makers and dark pools and iceberg order flows, always gunning for stops. So you don't want to wait for there because odds are you're going to get slippage and get a really horrible fill. So okay, well, nobody except Al S got it. And the answer is whole number resistance. One thing that I teach traders to do, and again, I did a stocks and commodities article on this, is to buy above whole numbers, say the 20 or 30 cents above a whole number resistance trigger, then sell the 80s, 90s. And that's the sweet spot of a pivot long trade, is buy right above a whole number, sell underneath the next whole number. That's a straight price action trade. That was a good bounce. This guy, I think I put in a trade today, but I think I bought 525 and got stopped out. So I tried to buy it here. I'd have to check my Fidelity account to see if I got stopped out. But one thing you're looking for is buying previous strength. Oftentimes, when you see a bearish cut pattern, what it'll do is it'll do a fake out to shake out all the weak hands who use previous support as their stop out level. So that illustrates a key point. And let's do a long play as well. Typically, right above a high, you'll get a false breakout that traps new traders and crashes and burns. And often it'll keep them running up without you. And if you've been on the wrong side of that trade as many thousands of times as I have over the last 20 years, you realize you need to have a false breakout filter. So add a minimum of 20, 30 cents, whatever, something above the obvious resistance. See, that would be a bad place to buy because it's too close to break out above the high. Just like that would be kind of a bad place to short because it's too close to right under the previous low. So if you were to have given it 20 cents, the short would have worked out, right? Let's see, how many of you trade ETFs? I'm curious. Oh, Dust really took it in the shorts. Gold and oil have been strong lately. Long UWT, last time it ran, I called it long for my traders for swing trades at 1050. And I said sell 19. That was right after the start of the new year. I said long guys over 1050, and I sell decades, just like whole numbers. We didn't get the exact top, but we got the middle. You never, quick tip, never ever buy anything with a 9 in it. That looks expensive, and often you'll get a reversal at say a 19. So if I buy a 1050, my exit target is right under the next decade value. In this case, it'd be the 19-ish, okay? Now it's dropped down and it's starting to bounce again. There's two technical support signals here. I don't see any really strong candle reversal patterns yet, but I do see a little window there, and I do see a lot of volume here, and I do see an increase. If you're bottom fishing, which is And Toni had a brilliant presentation, right? She's so smart. Anyway, I learned a lot from her over the last 20 years. I've known all these along. Anyway, since dinosaurs roamed Earth, we got the bullish engulfing on virtually every chart known to man back on the big day after Christmas reversal, right? The Christmas gift was the bullish engulfing. Anyway, and so that's why, and thanks to Steve for teaching me that kind of thing, I said to go long over 1050. It was right above that candle high. And we said the exit was up at the 19 region. Now it's starting to do another cycle bounce, right? And it may be good for a pivot. Something I'm keen on too is I trade TVIX almost every day because it's got lots of volatility. It's how to trade the VIX. I used to trade VXX, but when the market's sideways, like it's been up and down, the VIX is flat. Now I think the VIX is cheap at 18, and I was buying it yesterday. I didn't sell the top, okay? Even though I've been doing this 20 years, I'm not that good. I didn't get out at the exact top, but I was buying it on the way up. Here's a quick tip for you guys. Here's a quick play that I've done hundreds of times. It's very good and very consistent. I was telling a colleague, Jeff, about this. The closing spike in the TVIX. And I specialize in open range breakouts and trading the open. Hence, live trading room is www.tradingtheopen. Learn it, live it, join it. But trading the close and TVIX on a spike would be interesting to see if it spikes today. Often you get a price, and I was trading this successfully yesterday. It was just 170 shares, but I was trading this on the way up, and I sold this one I squeezed out right near the top. I got out at like 1894. I did a market sell order. I usually don't sell at market, but I was holding this guy all the way into the close yesterday. That's today's chart. And I sold 1894. So that's another arrow for your quiver, is look for bounces in TVIX. And none of the other ETFs do this one, but TVIX will often do a spike up that's a good successful trade setup into the close. This is an instrument where you buy support, sell resistance, buy support, resistance, buy support, sell resistance, buy support, sell resistance. Being the VIX instrument, you do not buy breakouts in TVIX unless you use really wide stops. It's usually better to buy on a pullback. Speaking of which, it's always good to look, and Harry had mentioned this too, looking for bull flags. It's a real honor to have so many people here that are so brilliant. I mean, these people I've all learned and I trust, you know, and they're people I recommend to other traders and family and friends and all that. They're actually really good people to learn from. So, but anyway, so I heard mention bull flags. That's a bull flag pullback. Now on a hot chart like this, you don't have to just trade the first one. Maybe you missed this one or you're kind of skeptical and yeah, I don't know, let's wait and see. Well, you could have traded this bull flag breakout here too, right? So either inflection point, either the high there or the pivot off the top of the flag, or just wait for a breakout. And it ran all the way up to, lo and behold, the 20 whole number resistance. Where is support on this guy? Hey, the magic answer key. I'm an expert in day trading these kind of instruments because I've done thousands. And that's why I sold it right under 19. It was like three. You guys ever do that? Like sell like at 358 or 359 with a market order. It's exciting. It's fun. It's like a video game, but with money. The Wall Street Casino. But you've got the edge because you know how to frickin' trade because you know the chart patterns like the back of your hand, right? Anyway, how many? And Stephen mentioned box trading ranges, whole numbers, box trading ranges. Frickin' brilliant, right? You buy above the high, put a stop on the low. Buy above the high, put a stop on the low. Whole number support, whole number midpoint. One thing that traders screw up and you guys don't pay enough attention to is the C part of the four-letter acronym that tells you about the range of an instrument. That'd be another good prize. Let's do another $5 Amazon gift certificate. C is the fourth letter of what? Four-letter acronym that describes specific important parts of an intraday trading range. C is the fourth letter in what four-letter acronym? I know it's late in the day, but you guys can do it. Glenn, you got it. Glenn got it. OHLC, you got it, man. So Glenn E, you win a prize. It said what four-letter acronym? Open, high, low, close. OHLC, right? So What you guys need to pay attention to for the current day, if you're going to day trade, you've got to set up your charts, by the way, just a quick tip. I am the original day trading university since the year 1999. Just like Steve, I'm widely copied. Pisses me the F off, but hey, get over it. Like my consultants tell me, they say, the sincerest form of flattery is being imitated. I don't know, it just irritates me. But the point is, make sure that your charts show starting at 7 a.m. so that you can see plenty of pre-market data to see the directional bias of the gaps, see if it's at breaking out of the trading range or not, if it's going horizontal, and what kind of volume you've got pre-market compared to the previous day's pre-market volume. All that type of stuff is critical intel as a trader. So I was trading TQQQ successfully today. I bought this on the breakout, and I think my trail stop was triggered somewhere over here, so I didn't get the exact big piece of it. But if you do trade the markets itself, it's important to look at trading volatile instruments. So the opposite of TQ, here's another quick tip. I've got so many of them, right? 20 freaking years of experience. And most of my speakers have more experience than me, so I'm really privileged to be in the company of those folks. Here's a intelligent trading strategy that I published. I think it's coming out in the next month's issue of Stocks and Commodities, if it's already out, is an ETF arbitrage approach. And this is a professional trader's approach. Hence, I do this virtually every single day. TQQQ is the opposite. It's the long leveraged Qs, and SQQQ is the opposite, the short triple Qs, right? Just like Nugget, I often Nugget, gold is going up. Nugget is up against dust, right? The short gold instrument. That's the inverse instrument. The long instrument is Nugget. Just like the opposite of UWT is DWT. But those are both kind of choppy. What you want to look for is the biggest percent from open instruments, and then look for trade setups. Let me ask for day traders out there. Let's say we want to live dangerously and we want to, well, let's not do that. Let's call it more safely. Let's say we want to buy, because you guys are all probably long biased, let's say we want to buy 2650 as long. Where would your initial stop be on, say, a 200 share trade? You've always got to evaluate risk management in terms of the share size, your initial stop, your exit target. So if I buy 2650, where would be an exit target? What we expect is that there's going to be a false breakout here. If you're following time and sales, a quick tape reading primer, and I've only got a few minutes here left, you're looking for trades to go off at the ask, which is bullish. You're looking for block trades. That's where icebergs are getting cracked, right? You've got dark pool liquidity coming in and high frequency trading algos are kicking in. When you have block trades, meaning over 1,000 shares going off at the ask in green, that's a good bullish continuation sign in a tape. But yet we expect the fake out because we're at resistance. And often the pattern is, by the way, do you guys like that I'm using actual like live charts? I'm a trader, I live on this stuff, right? Anyway, this is kind of like the worst place to buy a breakout because often it'll immediately go back down again. And if you've ever been screwed by those kind of breakouts, now having said that, watch it run to like 60, right? But point is, often this will stall and slow down, maybe at 26.50 within the first 10 or 20 cents of the obvious move. See, retail traders buy up here. Professional traders are selling to you guys up here, right? So always have a false breakout filter of a minimum 10, 20 cents above the current high before you get in. So personally, I would use 26.55. That's another pack in all these decades of experience. Another quick tip that a market maker told me when I was doing a seminar at MGM Grand in Vegas is he said, don't buy and sell off the dimes. I should give this away for free, but it's a good tip. It's valid. I want to give value to you guys. Use odd numbers within because market makers can't gun to stops if you're using, say, 26, or not as easily. They're playing the 26.50. I would wait till 26.55. Okay, so use a nickel or so above a current resistance area. Don't use the even number. I know it may seem like kind of splitting hairs, but it's very important because often it'll go like 26.51 and then crash and burn, if not here. So yeah, 26.30, good answer, folks. That would be the maximum stop you'd want to use on a breakout somewhere north of the 50. See, right now it may be in false breakout territory. It is breaking the new highs, but one of the tricks of the trade that you learn if you've been a veteran day trader, I'm one of the original .com, what they call the Sos bandits, and I got all these copycat imitators who say, yeah, me too. I know how to tape read. I'm the original tape reading expert. Look at my Active Trader magazine article from 15 years ago, or my online trader's first ever presentation in the year 2000 in Anaheim was on tape reading. Anyway, use the tape to avoid fakeouts. And so some of the signs to look for are if you've got, iceberg order flow, which means 100 and 200 shares at a time, that's usually not that's the tip of the iceberg. A market maker, if a market maker is trying to work say a 50,000 block client order flow into the market, he's not going to put on a 5,000 share trade, right? That'll spike the price up and his client will fire his butt, right? Because it's unfavorable to the VWAP. What you want to look for is when the iceberg gets cracked, when you point it, you see large numbers in the size column of over 1,000 shares that are green. We want to see a lot of green on the screen with trade shares of like the 1,300 block is nice. Let's see a bunch of them, right? You got all these little peanut gallery, me too. We're going to try and drag it down. Let's see if the battle between buyers and sellers continues on up. When trades go off in green, that means you've got trades at the ask, which is bullish. When it goes off at the red, that's bearish, okay? So that's one of the things to look for. And let's see, when it comes to using, the tape is all you need. You do not need level 2 unless you're trying to scalp thousands of shares, buy at the bid and sell at the ask and whatnot. Main thing is tape. This is a custom tape I designed. You do not want to use something like this. That's the default tape. Now, do you see from a professional trader standpoint, the tape on the left versus the tape on the right? Which one is more valid or useful from a price action trading standpoint? You can look at the little microscopic screen on the left and look at the bid and the ask exchange and the condition and the date and all that kind of crap you don't need. This does not help me trade. This is just kind of confusing and visual overwhelm, all right? As a veteran day trader, this is all we need, right? And see, I kept you guys out of the false breakout. Now, when you see a false breakout on an arbitrage play, what you want to do is flip over to, say, maybe a bounce and dust. Now, personally, I wouldn't hit it till 12.12 or so. I'd wait for it to break over the dime. It's still a bearish downtrend and it's likely to keep dropping, but it may bounce off the 12. And if it does, maybe hit it at 12.07, 12.08, right? Whole number support. The kind of the devilish thing about trading is it's a game of, like, get smart. I don't know how many of you are fans of 1960s TV like I am, but I love I Dream of Jeannie. I love Get Smart, and especially I like Wild Wild West. But anyway, missed it by that much. Sorry about that, Chief. We don't have a cone of silence. What we got is price action. What we're looking for is if we see a breakout over the whole number or a pivot over the whole number. One strategy you can also use, I highly recommend using candles and learning them from Steve Nison. Look for things like, and you'll often see on the 5-minute chart, usually gives more valid candle patterns. You'll often see bullish or bearish reversals. Not 100%, but often they will manifest themselves. For another $5 Amazon gift certificate, what's the bullish possible? It's the wrong color, but what's the bullish reversal pattern that we see 5 minutes ago in this? $5 Amazon gift certificate to the first correct answer. What time is it? It is, what's the bullish reversal candle pattern we see? Nope, it's not a bullish engulfing. Rajiv got it, Rajiv D. It is a hammer, not an inverted hammer, it's a hammer. It's hammer time, da ba da da ba da ba ba, and up and away we go. Anyway, so the 5 minute, I use the 1 minute candlestick chart, but the 5 minute will often give you clarity on breakouts like this, right? Or pivots like this. So seeing the brilliant thing was I did this live correctly, intelligently, in front of your very, very eyes. Who else is that good? I told you it'd be a false breakout right over the 40. I'd say we'd wait for it to get over the 50. If it doesn't, we go hunting for a pivot in the opposing ETF like this guy. And schwang, we're off to the races. Anyway, that kind of thought process is where you need to be at as a trader. It's not like, hey, let's buy 3,000. Have you guys seen these, like these morons under 40 years old, these young kids who don't know what they're talking about, making phony performance claims, trading cheap-ass $3 stocks with overseas brokers? I just made $6,000. Yeah, I don't think so, Sparky. Ask to see their tax return. You'll hear crickets chirp. There's so much BS out there. Learn the right way from people like the folks who I've honored to have, with you today. That's my vision. Let me close, wrap up for today. Long ass pitch fest with boring presentations from people that didn't know what they're talking about, like a lot of the multi-speaker events. This was, gold, the saying for, right? We all learned I learned some new techniques from the folks who presented, and I wanted to thank all of you for being here. So it means a lot to me. Got 1,200 folks registered, and it is my destiny. I've got my golden ticket offer. I usually don't do this, but you can get, this is not recurring, it's not a subscription. For just $97, the paltry sum of $97, you can get access to over 30 hours of training with me. My live trading room, right, which meets every single day from 9 till 10:30. The offer ends this Sunday. You can click on these links to learn more about the services. But basically, kind of like going to a great buffet in Vegas, like Caesar's Bacchanal Buffet, right? And you want to learn with me, and I'm the real deal. So hopefully you guys will want to take advantage of that. It's only $97. That's my golden ticket offer. And I wanted to thank y'all for being here. Let me ask you guys a quick favor. Pay it forward by, so that's the special offer. You get all access. Type in a testimonial or something you like best about today's event that I can put on the website. Would you guys like to see me do more of these? I've held off for years doing multi-speaker events because it is a hellacious lot of work, but you guys are worth it, because I want to show you guys the golden standard for how to, trade with the smart people the right way, not these young social media Instagram whiz kids who are, hey, I made $6,000 today trading a $3. No, they didn't. Hate to burst the bubble. If it sounds too good to be true, it is. Learn, by people, learn with people that actually have depth of expertise that have been around a few decades and know what the heck we're talking about. The only thing about my offer is Oompa Loompas are not included. Bada bing. My mad power, my Photoshop skills at work. Bum bum ba dum ba dum bum bum ba ba da ba da ba da bum bum bum. No Oompa Loompas, just great training. So anyway, hit it or quit it. TradeMastery.com/win, because that's what I want you guys to do. If you're still in a place in your trades where you are trying to explain your losses, or even worse, concealing your trading losses from family members, you probably got a problem. You're probably, like Barry's saying, probably over trading. Like Sosnoff said, and he's brilliant. He is. I learned so much from Sosnoff and all these people, but about volatility and risk management. It's law of large numbers. Like I say, take a lot of shots at the market. Where you guys screw up is you trade too large size. My average stop loss cost on my day trades is under $30, under 30. So I'll use a 20-cent stop on 100 shares, or 40-cent stop on 50 shares, or a nickel or dime stop on 200 shares. Play really super tight, and I play the game wide, not deep. I trade small, and I trade often. You guys are probably trying to make the big trading decision. Should I make the trade? Dump-a-dump-bum. And it's more, how to say, that's odd. The screen is black. Well, anyway, the point is you want to trade frequently and trade smartly. So Anyway, thanks so much for all of you for being here. I do appreciate it. And we are going to wrap up for today. So thank you, and take care. Best wishes for success. And I'll see you guys next time. Bye for now. And good to see all the kind words. Looks like this thing is frozen up, so. Thanks guys for being here. I know I kind of blazed at you with a lot of quick stuff, but my time is up, and I'm not going to take any more time than I kept my other presenters who, in an abundance of being fair, but I want to just thank all of you sincerely for making this a really successful deal. What is it? 1,230 people registered for this, so really big turnout. So okay, I will continue on with these. I will do these maybe once every 3 months or so. Does that sound good? But this is a nice quick alternative with 30-minute presentations from the best and the brightest people I can find, at least. Let me know if you know any great traders that I don't have on the world's top traders site you'd like to see. Requirement is they need to be highly trusted, well-respected, and well-known, over 40 years old, actually know what the F they're talking about, not these kids or bubblegum traders. And that's my pet peeve. I'm kind of like the contrarian. I like to give you guys the best. Now look, did I not say, I mean, I shit you not, right? I'm good at this shit. Sorry about the French, but sorry, Mira, but closing range spike in TVIX. Again, you could have made a little money with this, at least that's the pattern I mentioned to you guys at the start of my presentation. I wasn't trading it today because I was doing this, but the closing range move up in TVIX. Now it's not 100% of the days, but it's often enough to where it's worth taking a shot. And I hope you can make freaking money with this, right? The only thing is, like with anything, the obvious resistance is usually going to shake a little bit. So add 10 cents to the obvious resistance before getting in, and you're off to the races. But do you see pattern day traders? We look at the previous day pattern. You trade the current day with the same kind of cycles, the same kind of breakout patterns. Closing TVIX range. You could have made some change there. You could have some money. So, well, thanks, Gary. I agree. He's a good guy. Thanks, everyone. I do appreciate it. And yes, Renith, yeah, you can do another golden ticket. I know a lot of you, so many hundreds of you like that golden ticket offer. Yeah, you can sign up for another month, and I'll extend your time so you don't have to worry about missing days or whatnot. I know I'd offered it back in May. It was so popular, I thought I'd repeat it for you guys. But it's only through Sunday, okay? So, get this stuff. Get Steve's offer, get my offer, spend a few $100, learn things that can hopefully save you a multiple of that and hopefully get you in on the right trades more often. So, anyway, I'll be like a banana and we're going to split, right? I hate bad puns. But anyway, thanks so much for making the Trading Success Summit a success. It's in service of y'all that we do what we do, and hopefully help you turn the corner in your trades and make better winning trades more often. So, and the replay, a question from Chris Z, will be at my YouTube channel, youtube.com/trading television. youtube.com/trading television. Feel free to subscribe and click the notification icon. But anyway, I'll try and get that uploaded later today for you guys. So anyways, and hopefully the GoToWebinar, I'll get an email out from GoToWebinar as well. So thanks for being here. You guys have been amazing. Have an outstanding weekend ahead. Let's go get them, right? Let's kick Wall Street's butt and figure out how to not lose and make better winning trades more often. Build consistency into your approach by knowing the patterns and the strategies that people like myself and all of my esteemed guests who are really smart people. I learned a lot today as I picked up a few things myself. So it's always good to learn from smart people. Thank you for being here. I'm out of here. Have an amazing weekend. Stay safe. Trade small, trade smart, play the field, and let's do it. Take care, folks. Bye-bye.